For Germany, DAX futures pointing lower by 76 points, 0.4%. FTSE 100 futures back below that 7,600 line, looking to lose about 16 points. Over in France, the CAC lower by 29 points, off by 0.4%. A bit of a breather then after you hit year-to-date highs on Friday. I'm looking at energy and basic resources, but also the tech sector today, broadly across these futures, pointing lower between 0.2 and around 0.4%, Pretty.
So Tom is there talking a little bit about just the risk-off sentiment that you were seeing in futures. Well, the markets are officially open as we get some of the exchanges to get those initial trades. And I want to take you through the cross-asset picture once more, because as he was talking about the risk sentiment story really souring, well, you're seeing that not just in the futures market, but in the commodities market as well. I really emphasize that dollar story, but take a look at some of the more kind of exposed commodities. Iron ore, for example, is going to be very risk attached. Whereas if you look at, say, even some of the foreign exchange story, you're seeing the euro dollar higher simply as a function of that dollar weakness, but you're also seeing a slight bit into the Swiss franc. That speaks risk off as well. But again, that futures trade, the risk off story that Tom was just talking about, showing up in the markets here. We're starting to get those opening trades for the equity indices, and you can see it is broadly red over in Spain and Italy, the more peripheral risk off or riskier indexes. You're already seeing a pullback about 0.3%. Meanwhile, right here in the FTSE 100, down about 0.2%. The extra underperformer seems to be over in France, where you are seeing a pullback, an initial pullback, I should say, of about 0.4%. But remember, holiday trading is a really big part of this. You are seeing thin volume of only a couple more days until Christmas. So a lot of people are already wrapping things up. You are not going to see the Santa rally that's traditional over in the U.S. markets, whereas here, pulling out of the markets is actually quite normal. So again, that is your macro story. Let's get a little bit more deeper in there. Tom, walk us through the sector story.
Yeah, across these 12 main sectors that we look at then, 3 main sectors just in positive territory. Energy up 0.4%. We flagged this obviously because of the moves higher in prices. That links to what's happening in the Red Sea, of course, and the geopolitics that Critty broke down for us just in the last few minutes. And energy as a sector gaining on the back of higher oil prices that notched, by the way, last week, their first week of gains for a number of weeks. Energy up 0.4%. Basic resources actually flat. We've seen a little pressure coming through on iron ore prices and more warnings about the lackluster demand that could be coming through from China's steel mills and iron facilities in 2024. Autos is taking a big hit today, and that's leading the weakness that's coming through for Germany's DAX. Autos as a sector then down 0.9%. But we were also flagging what's happening in technology, and this ties to the China story. It ties to that evolving and expanding ban on iPhone and Apple products in China. Technology down 0.5%. Some of the suppliers there likely to be under pressure. We'll break that story down for you, give you more details. But so far as a sector down 0.5. The yield story, of course, may also be the mix for that sector. Industrials taking a hit at 0.6%. Banks also lower by around 0.3%. Food and beverage off by 0.5. And you've got a bit of pressure as well coming through from consumer products as a sector, one of the leading losers so far in the session, down 0.9%. Again, the green on the screen coming through for energy and health, just up 0.1% across your benchmark. 474 on the European benchmark, just down 0.4%, Critty.
So that, of course, is your sector story. Let's zoom out a little bit and bring in some of the macro themes that we are watching, of course, going into tomorrow. Sophia Horte-Costa joins us now from our Marcus Today blog this morning. Sophia, just when we thought central bank palooza was over, it isn't. We've got BOJ tomorrow. What should we be watching for at a time when, Smart Cudmore put it in the last hour, disappointment and confusion seems to be what we keep getting out of there?
Exactly, and the long yen trade it's almost too obvious right now, right? It's the world's most kind of popular popular trade in currency markets. And
Traders have actually been disappointed or let down by that trade for 3 years in a row. Now it looks so obvious because of this expectation that the BOJ will drop the negative rate. Not as soon as tomorrow, though, Kriti. So what we're looking at is we don't get the updated forecast from the BOJ. So Governor Ueda has two channels to talk to the market. One of them is the press conference, and he tends to be quite entertaining. That's during the Markets Today show, so that will be one to watch, but also the policy statement. From what traders are expecting is at least some guidance of when the negative interest rate could be dropped. I think that might be a little bit, to expect that might be a little bit too optimistic because Ueda likes to keep his cards close. But most economists expecting a change by April. Again, communication is key. Let's see if this central banker manages to convince the market, though.
Okay, the comedy factor from central bank speak. There's the context, of course. But relatively, he's amusing, isn't he, Ueda? So we'll see if he cracks any jokes later on Tuesday, of course. When it comes to the UK, the downbeat picture continues. We've got the Hawks sticking to their guns. They voted for hikes, of course, in the most recent meeting, 3 of them on the MPC. But the data expected to come out towards the end of this week for the UK is not looking pretty.
It's not, and that's the third quarter GDP. It's the final reading, but I should say that the last reading that we had, even though it showed a flat growth for the quarter, this is really geeky, Tom, but if you look at the actual numbers, it's minus 0.03. So it will only take a very small revision now to actually take us into a contraction for the third quarter, and that puts the UK at the risk of a recession. And obviously, that's a very different narrative. If you're talking about stagnating economy, okay, then maybe we could have a little bit of people maybe on the fence about the outlook for the UK. But actually, if hard data shows the economy in contraction, and it will only take a few percentage points or less than a percentage points here to move the needle, then you have a very, very different conversation at the Bank of England, Tom.
This is why it's worth reading the Markets Today blog, because Sophia Horta-Acosta brings the geekiness to the data and broke that down for us in great detail, comprehensive detail, just minutes, of course, after that data came through, and it was worth a read at the time. It's worth a read again. Sophia, thank you very much indeed. Sophia Horta-Acosta looking ahead to the data out of the UK later this week from our Markets Today blog, and you can get more, of course, from Sophia and the rest of the brilliant team on the front page of the Bloomberg UK website, or type TLIV GO on the terminal.
In the meantime, a quick check on what we're getting not only today, but in the week ahead. This morning at about 9 a.m. UK time, we get that German IFO data. It's going to talk to us a little bit about the strength of that German economy. Meanwhile, the ECB also holding its biannual conference on fiscal policy, as well as the EMU governance. We'll be hearing from speakers, including ECB Chief Economist Philip Lane and Executive Board Member Isabel Schnabel. Now, tomorrow it is the main event, which Sophia was just talking to us about, is the Bank of Japan meeting. The focus, whether Governor Ueda makes any changes to the world's last negative interest rate. And of course, how do the markets digest that? What does that mean for the global trade and the repercussions? Then later for the Federal Reserve and its peers. On Wednesday, watch out for the UK inflation data in November. Thursday, of course, we go from the big macro trade right down to the micro. Nike due to report their second quarter earnings. Of course, that's their fiscal second quarter earnings, not the calendar numbers. And on Friday, we'll get the UK retail sales numbers and that US PCE. So even though everyone's getting ready for the holidays, Tom, got plenty more to digest.
Yeah, and coming up, a corporate story for you in the fertilizer space in the Netherlands. OCI soaring, currently up 9.3%, that stock, after the company agreed to sell its US crop nutrient business to Koch Industries for $3.6 billion US. We'll get more of the details around that story, more of the stocks on the move, just after this break. Stay with us. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He called himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg.
Welcome back. Happy Monday. This is Markets Today. 10 minutes into your European trading day. You're seeing losses of 0.3% across the European benchmark. Three sectors clinging on to gains. Healthcare, top of the list, up 0.3%. Bottom of the list, you've got construction and material falling a little over 1%. Autos also taking a hit, 0.8%. Let's check in on some of the individual stocks on the move, though, this Monday morning with Joe Easton. Joe.
So we've got the two big shipping giants in Europe, both gaining even further after those rises on Friday as Maersk and Hapag-Lloyd both do halt their journeys through the Red Sea, given disruption following those attacks on some ships and some safety concerns there. Pretty remarkable moves given that Hapag rose more than 10% on Friday, so extending those gains as well. Also the perfect excuse if the Christmas gift doesn't arrive for the missus. I think it's stuck in the Red Sea. Let's just hope she's not watching today. But in terms of the chip stocks, they are declining. Infineon and also ST Micro, both Apple suppliers, and we got that news out of China that they are potentially banning some workers from bringing their mobile phones that are made by foreign companies into work, and that is weighing on suppliers. We saw the likes of LG over in Asia also declining, so a couple of those in Europe also seeing weakness today as well. Then we'll flip over and look at OCI. You mentioned earlier a big move for that stock today, up almost 10%. They are selling another unit, this time over to Koch Industries in the US. It's $3.6 billion, and that stock fell by around 15% on Friday, so we're seeing it recovering most of that decline. That was on disappointment about a potential full takeover not happening. In terms of Croda, this is also in chemicals. They're announcing their CFO is leaving today, and they've also snuck in a small profit warning in the statement as well. Some of their earnings will be at the low end of expectations, according to them, out of London. Now, Casino, they are selling a whole swathe of their shops to Carrefour, the big French grocery rival, but that one's actually in a trading halt at the moment. I saw it indicated up double-digit percent on that news as well, but that one will have to wait for a price on that. In terms of the healthcare space, we've got Diasorin. Now, this one is a profit warning. They do diagnostic testing. It's out of Italy, based in Milan. It's a €5 billion company, so it's pretty big, and a negative read for the healthcare sector on that one today. Then in terms of a couple of other earnings we've got, and also a few ratings changes, we've got Seconomy. This is online retail from Germany. Looked pretty weak in some of their guidance in terms of their Christmas update, heading into that saying it's not been as strong as expected. Vodafone is breaking news, potentially tying up with Iliad on their Italian operations. That one did break just a few minutes ago. And then one for Games Workshop fans, those tabletop Battle Games, Games Workshop confirming it's doing a TV and film series with Amazon. That was speculated a few months ago, sent the stock higher, that getting confirmed today. And then finally, down the bottom here, Kering, Morgan Stanley cutting its price target to €400 a piece. They say they've noted that the company's new lines of clothing are not hitting with some of those aspirational buyers. They're only equal weight. They don't recommend selling, but they're cutting the price target to €400. So at 410 at the moment and coming down about 2% in Paris.
Joe Easton there from our equities team walking us through those initial market movers. We thank you so much this morning. Now, look, one of the big questions going into 2024 is what do you need to actually hop into the equities market when it feels like the bond bull market is just getting underway? You can kind of see that this morning, at least a little bit of a pullback when it comes to those European stocks. But does that sustain going into the new year? Joining us now, Haig Bathgate, head of investments over at Adamus Wealth. Let's start there. What do you need to hop into the European market?
Yeah, so I think, again, it's everything's back down to what you think is going to happen with interest rates. If you think interest rates are going to fall, which is ultimately what our view is, faster than what the market is probably predicting at the moment, you still want to be in fixed income. And obviously at the long end of the curve, you've got this amazing convexity because a lot of that debt was issued when interest rates were really low. And then you want to be in long duration equities. So tech, growth companies will respond very well in that kind of environment. So that's a very positive view in the market, obviously, because it's quite a high octane area of markets, both in bonds and equities. But that's where we see the value.
So, Haig, to be clear, you think rates are going to come down faster than the markets predict? That's in the US, that's in Europe. Where does that land? Kind of expand on that view then.
Yeah, so particularly in Europe and the UK, the UK does not look in a good state, as you were alluding to just a few minutes ago. I think we're going to see data prints really bad coming in later this week and into next year in the UK. And I think what we're seeing is a lot of the central bankers are hedging their bets. So you can see, 1 week they're saying, we need to have evidence that that there's enough disinflationary pressures to cut rates, and then they're saying, we'll slow down a bit. So central bankers are not going to be drawn on this, and they're going to wait for the data to confirm. And obviously Andrew Bailey came under a lot of pressure and criticism for not reacting quickly enough. So I think they'll wait for the data to confirm the position. But I think the idea that we float into this Goldilocks soft landing is, history would tell you it's highly unlikely.
One of the, and this is a controversial statement, but I'm going to say it anyway, one of the things that people tend to like about recessions or bad data or any kind of doom and gloom you have there is that it creates buying opportunities for those who are kind of being bottom feeders, basically. Do we see that for UK equities in particular?
Yeah, the thing is, for the entire time I've been in the markets now for 25 years, and everybody's been telling me that UK equities are great value, but they haven't re-rated yet. I think the problem is that we're seeing an exodus of capital from the UK. You can see the companies that are delisting from the UK and relisting elsewhere. I think the big issue we've got, though, is if interest rates remain as high as they are, it's going to spill into the real economy. We've got 23% of the European high-yield debt market that's due up for refinancing in the next 2 years. The majority of that is in 2025, but I think the markets will start to look at that midway through next year if we don't see rates appreciably lower. And we've got 12% of the US high-yield market due for refinancing as well. So there's a real risk that we start to see quite a material increase in the default cycle.
And you flagged the pressure on the property sector here in the UK a number of times. Mm-hmm. The team at Bloomberg Economics, they still hold on to their forecast that the first cut from the Bank of England comes in May, but they do concede that if the data changes and moves radically to the downside, as you've predicted may happen, then they could pull that forward to March, but no earlier than March. So where do you land on the first cut for the BOE?
Yeah, I think that's probably about right. Again, we have to see what happens with the data, but we have had very strong wage growth, so that's likely to have a bit of a latent impact. That's offset to a degree by debt servicing costs, and we can see they're becoming more and more onerous. Of course, what everybody's trying to predict is when all that money that was saved up during lockdown sort of disappears, and we're seeing debt servicing costs, credit card costs.
So to be clear, that wouldn't be a catalyst for you to increase exposure to UK equities?
No, again, we look through this, so I think as soon as the market starts predicting that and pricing that in properly, the Bank of England are still resisting that. You can see there's been a lot more commentary from the Fed talking about rate cuts than there has been from the Bank of England. So I still don't think that's priced in as much as it is perhaps in the US.
In terms then, if you are looking at, say, gilts, for example, versus treasuries, there's a global narrative that you're going to see rates lower around the world. How do you then differentiate between exposure between both sides of the Atlantic?
Yeah, so I think, look, it's my personal view, and our company view is that rates will fall quicker in the UK because the economy is not as well positioned as in the US. So if anything, you're going to get more persistent inflationary pressures in the US. The US is just better at adapting, as we see in every single economic cycle. So on that basis, if you're looking for this sort of duration pickup, if you're looking to play the convexity, the UK market is probably the best place to do it. And for private individuals, it's incredibly tax efficient because any gains on gilts are tax free in the hands of individuals.
So, but the central bank of the week is the BOJ.
Yeah.
If you're starting to think about the end of negative rates in Japan, which most people are, depends on the timing, of course, how do you want to be positioning for that scenario? The end of negative rates in Japan, where does that take you within the equity markets or the bond markets of Japan?
Yeah, well, I think it's interesting, isn't it? So what we're seeing is quite a different cycle in Asia. Unquestionably, Japan have managed to maintain this position because of the poor economic data coming out of China. Obviously, one of the biggest export markets in Asia for Japan is China. So I think, look, we have to see what's going to happen. They don't have anything like the same wage pressures that we're seeing in the Western world, and there's ongoing negotiations. I think it's a key date in April in terms of negotiation in Japan on wages. So I think they can kick this can down the road a little bit, and they're going to be pretty reluctant to change that. Having said that, I was in Japan in 2016 when they swore they weren't going to move rates negative, and a week later they moved them negative. So,
which is why this meeting is nonetheless going to be very interesting indeed. Hey, Barthgate, thank you very much indeed with the context and the view there in terms of how to think about 2024 in a potentially lower rate environment, with a view there on technology in the US and question marks about the valuation calls in the UK. Hey, Barthgate, Head of Investments at Atomus Wealth. Coming up, we're going to take a look at retail sales and consumer spending in the run-up to the Christmas season, the holiday season, as Europe's economies stagnate. More on that next. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Welcome back. This is Markets Today. We are 22 minutes into the European trading day. You're seeing losses of around 0.4% now across the European benchmark. Across your sectors, biggest losses coming through for autos, currently down 1.3%. US futures, though, holding on to gains of 0.1% for the S&P EMEs. Nasdaq futures are essentially flat. It is, of course, Christmas shopping season, the holiday shopping season in full swing, but mounting insolvencies and stalling retail sales. So we take an optimistic story and we turn it negative for you. In the run-up to the 25th stands in contrast to the recent optimism. There's the optimism in some UK business and consumer surveys. Joining us to unpack, nice work here, or rather unwrap this all is Bloomberg's UK retail reporter Katie Linsell. Well done, producers. That was nice. Katie, how are the retail sales looking then in the lead up to the holiday season? Are we still spending in this dire and bleak environment?
Well, so the answer is we're certainly spending. This is the key time of year for consumer spending, the key time of year for retailers. But I'm afraid I'm going to put a bit of doom and gloom in there, because if we look at the data we have so far on how spending has gone, the November figures have not come through very encouragingly. We saw that retail growth in November was weaker than expected. And if we look beyond the core retail into non-food, retail figures, actually the sales fell in November, which is really not what you want in that early run-up to Christmas. Sure, a lot of consumers do leave their shopping to maybe this week indeed, the sort of last run up to Christmas, but we would have hoped for better in November.
Have you finished your Christmas shopping, Katie?
I have a few items left, but I'm actually feeling quite confident this year. I have to admit that a lot of it was done online, and I think that's one of the key things, to look at the split between online and in-store.
Yeah.
I mean, maybe it is smart. I think a lot of shoppers are getting back into stores now. You know, we still have in our memory COVID lockdowns. We still want, if we can get out, we want to get out into stores. So it looks very busy in some of our key sort of shopping destinations, in London at least.
I have to say, I'm bracing for Oxford Street later today.
Yes.
And it's going to be a crush, I know.
Good luck.
But because I've been bad at planning, unlike you. Where are people spending their money? You talked about food. Are we spending our money more on luxury food in the lead up to the holiday season,
Yes.
and less on clothes?
I think food is the key area to look at, because it's a necessity. We all need to eat. And then if you look at the fact that inflation has pushed up food prices so much, whether we like it or not, we're going to be spending more on food. Even if you stick to your same category supermarket where you shop all year round, you're going to be going for the more premium items in that supermarket. We also see shoppers actually trade up to more premium, more expensive supermarkets at Christmas time. Kantar, who track data on supermarket spending, expect sales to exceed £13 billion, which is going to be a record this Christmas. So the supermarkets are looking quite happy.
Is this different then when we're talking about even years prior, for example? I mean, you're talking about luxury food as well, but we are in the midst of a cost of living crisis that doesn't seem to be going away for years.
Absolutely. I think shoppers are really aware of their spend this year. Mortgage rates are a key thing to look at. I think people are going to be really watching their spend, but I think especially on gifts. We've seen anecdotally that buying of jewellery and watches has really come back. People are going to be spending instead on sort of beauty items that are quite affordable. As we said, on food, which is a necessity, and you want to have your family and friends round. So I think people are watching their spend as much as possible this year.
Okay, affordable luxury maybe getting a bit of upside. And interesting on the supermarkets, the likes of Waitrose, etc., maybe holding up okay as we kind of switch up to more luxury food items, even as we dial back our spending on things like luxury jewelry, something that Critty is not doing. Critty, I hear.
Well, I'm just learning what luxury food is. This is a little bit of a culture shock. I figured luxury food meant, you know, like Swiss chocolates or something. I did not realize it was more than that.
So it's the lady who does her weekly spend at Fortnum & Mason. Is that right? I think that's right.
Gosh.
Yeah, there we go. Critty.
Charge it all to the Bloomberg Amex.
Katie Linsell, thank you very much indeed with the pre-shopping preview there and what it could mean for retailers and, of course, our appetite to spend. Critty.
Yeah, a lot to digest there. Of course, coming up, we have plenty more to cover. Oil higher. Egypt saying it's monitoring Red Sea tensions. We'll have it up next. Stick with us. This is Bloomberg.
The stakes are higher.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
This is Markets Today. We're about 30 minutes into the European trading day. Let's get to our top stories. European stocks sliding after Fed officials pushing back against bets of aggressive rate cuts in 2024. Two-year Treasury yields dip amid thin holiday volume. Meanwhile, Israel's foreign minister dismisses appeals for a ceasefire as European lenders call for a, quote, sustainable ceasefire in Gaza. And shipping stocks in focus as major container companies suspend transit through the Red Sea due to increasing threats to their vessels. There's a lot to digest from the geopolitics of the monetary policy, not to mention the positioning among this very light holiday volume. Tom, what do you make of it all when it comes to the markets?
Well, of course, we had the Fed officials pushing back, some of them at least over the last 24, 48 hours. To what extent does that actually make you question the guidance that we get from the Fed and those dot plots, of course, that came through towards the end of last week, towards the end of last week, of course? And to what extent do you buy that pushback coming from the likes of Goolsbee and others when it comes to the pricing of rate cuts? The other factor, of course, is the geopolitics and the oil story. We'll break that out for you in terms of the energy impact. Across the European benchmark, you are seeing losses today, so far in the session, 0.3% after you hit a year-to-date high again on Friday. The DAX is being hit by what's happening in the auto sector, because that's one of the leading losers, if not the biggest losses coming through for the auto sector. We'll break down the sectors just in the next few seconds. Down 72 points so far then. The German benchmark at 16,678, down 0.4%. Energy, though, is the lift for the FTSE 100. Marginal, of course, but you're adding just 4 points, 7,580. But it's that sector that is gaining and giving the FTSE 100 a little bit of upside so far in the session. Let's flip the board then and look at the breakdown across these sectors, and we will zero in on the energy space, up 0.6%, and you can link that, of course, to the concerns around the Red Sea and the blockages potentially coming through there, and how that has pushed up oil prices in the session today. And as a sector then, you're seeing gains of 0.6%. Health is also performing relatively well, adding 0.3% so far in the session, and basic resources getting a lift as well, up 0.3, despite a little softness coming through for iron ore and further concerns about the demand for steel producers from steel producers in China. So three sectors out of the 12 main ones that are currently in positive territory. But the downside is there. Consumer products down almost 1%. Personal products as well, down 0.6%. Food and beverage taking a bit of a hit. Industrials off by 0.5%. Where's autos? Down 1.3%. That's the biggest loser so far across these sectors. Banks also off of just 0.1%. Technology, you can tie that to the Apple story and some of the chip makers here in Europe as we look at potentially further squeezes on Apple and its ability to sell into that Chinese market. Tech as a sector down 0.7%. But the biggest losses, once again, the auto sector. That's heading the DAX down 0.4%. Across your benchmark, 475 here in Europe, off by 0.3% is Critty.
Yeah, let's get to our top story. And you kind of alluded to it there, some of the geopolitical tensions that are really moving some pieces of this market. Israel pushing back on intensifying calls for a ceasefire. It comes after France, the UK, and Germany urged a, quote, sustainable ceasefire as the civilian death toll mounts and tensions in the wider region continue to simmer. Joining us now, Bloomberg's Paul Wallace, joining us from Dubai. Paul, how is Benjamin Netanyahu going to be approaching this? Is he going to be heeding the warnings from these European leaders?
Hi, Kriti. At the moment, the answer looks like he won't be. Both he and his ministers have been very clear that this war in the Gaza Strip will continue until they feel that Hamas is effectively no longer and certainly isn't a military force capable of attacking Israel again. But it is significant that European nations are stepping up their calls for a pause in fighting or a ceasefire, depending on the exact wording that they're using in different cases. The most important player, of course, in all of this is the US. That's who Israel really listens to. And so far, the US continues to back Israel. And over the weekend, US officials said that it's up to Israel to decide when Hamas is no longer a fighting force capable of mounting operations from the Gaza Strip again. So when it comes to Washington, Washington is still backing and firmly backing Israel's plan to continue until Hamas is destroyed as an organization.
Paul, what do we know about domestic support, though, for this conflict? We're in 3 months now. 3 months that this conflict has dragged on between Israel and Hamas. How is the domestic support holding up, and particularly the support for Netanyahu?
Exactly. We are almost 3 months into it now. It is costing a lot economically. This is a very, very expensive war. By Israeli estimates, it's costing about $250 million every day in terms of direct expenses and lost revenues. And I think in a lot of ways it will be the domestic pressure that Benjamin Netanyahu and his cabinet ministers care more about than outside pressure. We saw protests in the last few days after it was announced that the IDF had killed 3 Israeli hostages. And I'm not saying that's a turning point, but it's a thing that could become a turning point or be seen as one in the future. If we have more incidents like that and we see more protests against Netanyahu, that is probably the one thing that will force the Israeli government to think about ceasing military operations in the Gaza Strip.
Okay, fascinating. So the importance of checking in on the domestic pressures there, as well as the external pressures and support that continues, of course, from the US. Paul Wallace with the context on the latest developments involving that conflict between Israel and Hamas. Thank you very much indeed. Now, in the fallout, of course, from that conflict, major global shipping firms are saying they are pausing transiting the Red Sea due to growing tensions in the area. We know a number of ships have been targeted. Joining us for more is Bloomberg's Brendan Murray, who has been writing comprehensively on the impact of this. Brendan, talk to us about what is being felt across the shipping lanes then, and the potential inflationary impacts of all of this.
So the Suez Canal handles about 10% of global trade, so a fairly significant amount. And when ships, whether they're tanker ships or container ships or bulk commodity ships, start diverting, that stretches the capacity of the shipping industry overall. So what happens is it takes about 7 to 10 more days to go around the southern tip of Africa if a ship is going from Asia to Europe, or even from Asia to the east coast of the U.S. So we're going to see freight rates go up because of this, at least on some of these routes. Freight rates have been low pretty much all year, taking some pressure off the inflation side of things. So just as we thought inflation is coming down, we're going to see some inflationary pressures from the shipping industry.
And we already know that there are 2 U.S. Navy vessels in the Red Sea right now. That doesn't seem to be doing much to stopping some of the attacks. What is the international response off the back of that?
Right. This is the big question that the shipping companies are waiting to see. A few days ago, they put out a call for a greater political response here, whether it's going to take more ships in the region to protect the commercial the vessels that are passing through. It is a big question, and this will either turn into a disruption that lasts a week or 2 until a greater protection can come to the region, or we may be looking at this for a few months if it drags on and the attacks have the effect of diverting ships to other routes.
Well, talk to us about the timing of all of this here, because, of course, it's holiday season. We know that e-commerce is going to be high as well. You also mentioned that freight rates have been low all year long. Does that perhaps offset some of the pressure that you're now going to see, just given the dynamic we've been in?
Absolutely. So the shipping industry in general has more capacity than it needs right now. So some of this stretched capacity from these disruptions will sort of be absorbed into that. But this won't affect Christmas shipments. All presents are already purchased. But what happens after the holidays is retailers start to restock their inventories in January and February, and you have the Chinese New Year holiday in early February. They try to get all those orders booked before then and on the water. So this capacity constraint is going to hit right at one of the 2 or 3 peak seasons for shipping. So just adding to the disruptions that we're already going to see.
It's really fascinating. I mean, the effects that you're already seeing kind of trickled in the market yet, but not fully there. But the freight rate increases are really interesting. You're already seeing this in insurance insurance increase, I should say. Even tanker rates are getting a little bit more expensive. Bloomberg's Brendan Murray all over that story for us. We thank you as always. Now, Tom, that is kind of the nerdiness of the morning. That's what I've been reading all morning. What catches your eye?
Well, that links to the oil price action we're seeing in the session, doesn't it? And the lift to the energy sector, and oil prices are higher. But the longer term story is about more output, particularly coming from the US when it comes to that oil story. And that takes me to the must read of the day, which is a piece that is titled on the Bloomberg, US shale surprise oil production surge posing a threat to OPEC. Here's a chart that really exemplifies what has been going on in terms of that output push coming through from US shale and the challenge that it poses to OPEC Plus as they struggle to put a floor under prices. Yes, prices are up today. Yes, they were up yesterday. But of course, the longer term picture for many is that demand output increase and the demand softness coming through, maybe from the likes of the US, China and Europe. The forecast had been about this time last year that the US would be producing about 12.5 million barrels per day. Well, you're actually at around 13.3 million barrels per day. That difference, by the way, that gap that you're seeing there, that's equivalent to adding a Venezuela onto the oil markets. And this is all happening despite the fact that the rig count in the US, the working rig count is down about 20%, and yet they are pumping record amounts of oil. Why is that? Because of innovations and efficiencies. We know the US shale industry has been ahead of the curve in terms of implementing and putting through those technological changes to make sure that they can extract more oil from existing wells, and that is what's happening. The US clearly played a huge role in the global market in 2023, including pressuring OPEC Plus to curtail their output. One of the key lines coming through from this must-read of the day, that's a quote from Ryan Duman, who's an analyst around this space. This is really worth a read if you want a better understanding of the pressures coming through for oil and what that could look like in 2024.
Yeah, really interesting dynamic there. And we were talking earlier about the spread between Brent crude and NYMEX, and it feels like this is perhaps another factor yet to consider of why you're seeing NYMEX crude is really pull back by about $5 or so. Tom McKenzie, certainly one to read, and sure, I will definitely go back to my desk and do that as well. In the meantime, it's going to be a theme that carries on into 2024 alongside the debt story coming up. That's where we go next. The $1.3 trillion debt-fueled M&A boom facing a tough new reality. High interest rates starting to bite. That's the subject of today's Big Take Deep Dive coming up next. Stick with us. This is Bloomberg.
Much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Markets Today. We're about 45 minutes into the European trading day, a mostly down day when you look at some of the European indexes. I mean, look, this is pretty normal, very light holiday volume going into Christmas and the New Year. So it's only natural for some people to take a little bit of positioning off the table. It kind of feels like that's what we're seeing amid a fairly quiet trading day. And that's why we go to something perhaps a little bit more interesting in the corporate space. Halfway through Jamie Dimon's special incentive to stay 5 more years at the top of JP Morgan, the bank's succession plan still pretty unclear. Bloomberg's Sue Keenan has the details.
Jamie Dimon is viewed as a fiery CEO who's not going anywhere anytime soon. In fact, he's famous for avoiding questions about retirement or succession, and he made it clear back in 2009 he thought it was in his best interest to avoid such questions, which he referred to as drama. But that hasn't stopped speculation within the bank about who the frontrunners to succeed him might be. A management shuffle in mid-2021 put 2 co-heads of the Consumer and Community Bank division in the spotlight, just as the bank gave Dimon a big bonus to stay on another 5 years. Marianne Lake and Jennifer Piepzak are widely seen as frontrunners or top contenders, although the insiders say neither is the clear frontrunner, nor have they vied for the top job. The insiders are predicting more senior leadership changes or reshuffling might be needed to give these contenders more experience to run the whole company. At the same time, JP Morgan Chase is more profitable than ever under Dimon, who's been there for 18 years. The stock is up 23% year to date. It hit a high for the year on Friday. Sue Keenan, New York, for Bloomberg.
Okay, Sue Keenan there on a look at JP Morgan and the challenges around finding someone to replace Jamie Dimon. The lineup there, of course. So from Jamie Dimon and JP Morgan to the broader financing space, and many companies that relied on cheap credit to bankroll takeover deals, well, they're now running into a bit of a similar problem, or a familiar problem: how to keep lofty M&A promises while servicing large debt loads. That is the subject of today's Bloomberg Big Take. We are joined now by Neil Callanan, who is and heads up Bloomberg's corporate finance coverage. The promise often when these deals are made is that we are going to create efficiencies, we're going to cut costs. Yes, we're leveraging up to do this deal, but it's going to pay off long term. What have you found out? And you've lifted the lid on some of these companies. To what extent they've been able to push through some of those promises, Neil?
Yeah, the big takeaway is they're struggling to deliver those promises, and they're struggling quite a lot to do so. And that is going to have knock-on implications in everything from the bond market to the leveraged loan market in the coming years, because a lot of the leverage that people took out at the time of M&A was dependent on those synergies being achieved. And if they're not, then the company is going to struggle to keep the earnings revenue to even be able to pay its interest bills. So one of the takeaways from our story is that nearly a third of the companies have leverage ratio above 3.5, compared with 16 before the acquisitions. And if you think about that, you're generally talking about being downgraded into a junk status if you're crudely between 3 and 3.5. So you have almost a third above that. And so if they're not delivering those cost synergies, then the risk is they get downgraded to junk, and then they face a massive spike in their borrowing costs, and that's a big problem going forward for profits.
Some of these credit ratings agencies famously are late to the game. Are they ahead of the curve this time?
So the research we've looked at suggests that they're still being sluggish around the issue of downgrades. And in fact, one of the studies we cite in the piece seems to suggest that companies that are in danger of becoming fallen angels, so that downgrade into junk status, actually go and do M&A deals to try and put off those ratings downgrades and make new promises about what they're going to do. That's going to be an interesting one looking forward as to whether the ratings companies look at those ratios again and start to move more speedily, as they did during COVID. But they say those leverage ratios are quite crude, and they look at other metrics as well. There's still a feeling in the market that they can be a bit slow.
It takes you to that famous line from Warren Buffett: when the tide goes out, you see who's been swimming naked. When it comes to the M&A picture, as we look ahead to 2024, Neil, in this environment where expectations are rates will be cut, is M&A going to get a lift from that? Is M&A going to get a boost? Is it looking better 2024?
I think in deal volume you may well see a boost, but in terms of deal value, I think we're not going to see the same amount of transformative deals that we have been seeing in recent past. So we talked to 7 CFOs as part of this piece. Nearly all of them said that they were looking at bolt-on acquisitions, so that's where the volume side comes in terms of add-ons. But in terms of value, it would take somebody very brave to do a transformative deal at this stage, given the price of debt, given the focus on earnings, given the consumer outlook is starting to waver a bit. It would be very hard for companies to kind of do those transcendental deals unless they have a lot of cash on the balance sheet, and that may change the dynamics slightly.
Bloomberg's Neil Callahan, we thank you so much for bringing us that crucial story. Of course, something that I'm sure will have ripple effects into 2024. Meanwhile, coming up on the program, the Bank of Japan widely expected to scrap negative rates by April. We're going to look at what to expect from the central bank's two-day meeting kicking off today. Stick with us. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Five of the biggest names in business choose Bloomberg.
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Happy Monday. This is Markets Today. We are 52 minutes into the European trading day. You're seeing losses of about 1/10% now on the benchmark here in Europe. So bearing some of the heavier downside that we saw at the start of the session, energy is gaining at the top of the list up 0.9%. Construction and materials at the bottom, along with autos down about 1% for both of those sectors. Let's zoom out though. Go back to the Bank of Japan story, the central bank story of the week, arguably, and cross over, get the analysis with Venram from our Markets Live team, our MLive team. Ven, why is buying the yen not the most obvious trade out there right now?
Well, it's not the obvious trade right now because of what the BOJ is not going to do anything tomorrow. If you look at the rates markets, if you look at the OIS markets, everyone is thinking that tomorrow is not when the action is going to happen. And therefore, and the yen has run up some 6% in the past 5 weeks. So the hurdle for further yen rally from here on over the short term is very little. But if you pan the camera to 2024 and look at what happens after the spring, I think the picture gets considerably rosier for the yen because that's when the BOJ is supposed to act. That's when they were going to normalize policy. That may happen in March or April, but either of those months will do for the yen. And if you also got the Fed that is likely to cut rates around that period. So if you put together both of those factors, they're both positive and accretive for the yen. So the short-term picture is murky for the yen, but the longer-term picture is decidedly rosier.
Can you give us a number on that, though? We had Eric Nelson, our Wells Fargo strategist, join us in the last, I think, 2 hours at the 6 a.m. show, I should say. And he said that in the spring, again, you could see dollar yen get down to 135. Your take on that call?
Oh, I hadn't seen that, but I was just conferring with a colleague, and we were both agree that 134 or thereabouts is the level to watch, because I think that that kind of run-up is definitely possible, but it depends on how much further the Bank of Japan is willing to go beyond zero interest rates. If they say 25 to 50 basis points next year, then it can push further higher than just 134 even.
Yeah, Ven, what do you make of this pushback that we've got from Fed officials? How seriously should we take it over the last couple of days or so? On the dot plot, 75 basis points, it's there, it's written down. Yes, it's not a commitment, but it's the forecast. And then we have the officials coming out and pushing back. I just wonder what it does to Fed credibility in terms of their messaging, in terms of their forward guidance, and what it does for the yield curve.
The messaging is all muddled, no question about that, Tom, because, as you said, 75 basis points of rate cuts penciled in. They're penciling in a core PCE of 2.4% for next year. So if their inflation projections have been pretty good, so if inflation marches down to 2.4%, do you really need a Fed funds rate, mid funds rate at 5.375? The answer is not if you ask the Fed, and therefore they're thinking that 75 basis points of reduction is possible. Regardless of what John Williams has said and what Bostic have said, I think that the markets are not buying that message simply because the direction of yields is lower. And at the moment, they're fully priced, but there is no material incentive for yields to push higher from here.
All right, Ben Rom there from our Markets Live team, walking us through kind of the dynamics you're seeing both in the Treasuries and the JGB market as well. And of course, remember, you can get up-to-date analysis and insight from Ben and the rest of the team. Just type in MLIV Go on your Bloomberg terminal for the full Markets Live analysis. Now, in the last 30 seconds or so, Tom, I got to say, my big question is, what is the floor in yields if you see all of these pressures?
Yeah, indeed. And whether or not the data of this week as well, PCE on Friday, to what extent that either confirms the bias in these markets or actually aligns with the Fed speak that we've been hearing. And I know you're focused on oil as well.
Yeah, lots of oil. Does it trade in line with the cross-asset story that you're seeing? Maybe, maybe not. That does it for market today. You can get insights from the team and the rest on Bloomberg UK and TLIV Go. Stick with us. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're
in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
priorities.
Could face bigger challenges.
Britain's next. It was going to keep rain World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Fed officials push back against bets of aggressive rate cuts next year, threatening a bumper global stock rally. Israel dismisses a call by European leaders for a sustainable ceasefire in Gaza. Meanwhile, global shipping companies are on alert amid rising threats to containers in the Red Sea. Plus, China's iPhone ban ramps up, with more staff set to be barred from bringing foreign mobile devices into the office. So first things first, we have the IFO numbers. So we'll get onto that in a second. I'm also really looking forward to our conversation with Clement Fust to try and understand what the German economy does next. Now, that December IFO business confidence coming in at 86.4 instead of the estimate 87.7. So it is a little bit below estimates, but at the same time, there's, I guess, so much bias that central banks will be here to support a lot of the stocks that we're seeing gains pretty much in tandem with that. So European stocks a little bit hesitant. We did have a weak session in Asia. Again, this is after the Federal Reserve actually pushed back against bets of aggressive interest rate cuts next year. Dollar broadly steady. Yields on 2-year treasuries dropping 2 basis points, trimming gains made on Friday. We did hear then the New York Fed President John Williams leading a course of officials in saying it's just too early to begin to think about lower borrowing costs. So we have the IFO figures. We'll have everything, of course, to look at what 2024 will bring in just a moment. We'll be getting more insights from the IFO Institute President. He's Clement Fust. But let's get another take on the German-European economy with T.S. Lombard's Head of Macro Strategy, Skyler Montgomery Koenig. Skyler, as always, thanks so much for joining us. Now, first of all, I know we're looking at the German economy with the IFO Institute, but in general, if you look at some of these stocks, there's a lot of question on whether, the Fed can really ease and cut as much as the markets are pricing in.
Yeah, absolutely. I think people are really questioning what the Fed can do. And what you don't see is what's under the hood, right? In terms of if you look at short-term interest rate markets, they are an accumulation of views. And I think the market's really caught between two views. One being we get a recession and significant Fed cuts because we are in restrictive territory. And to get down to not restrictive or even neutral, you need to cut a lot. Or we get a soft landing and something more in line with the Fed dots, which is something like 75 basis points, and the market's pricing quite a lot more than that. So I think, the market and consensus is stuck between these two scenarios, and the equity market would rather run with the soft landing narrative than the recession one.
But does it make sense, Skyler, if you look at the everything rally, does it actually make sense given all of the uneasiness that we're seeing with the economy and the fact that even if the Fed were to cut interest rates soon, we don't really know if that's a good thing because they just see inflation going down or whether they worry about a heavy recession?
This is the struggle, right? Because all else being equal, lower rates is good for equities and it's good for bonds. For equities, it means future cash flows are discounted at a lower rate. The problem is that interest rates are usually cut when the economy is slowing. And equities care about growth because slowing growth means slowing earnings. And if you look at the past 10 easing cycles, on average, returns are actually positive, but there's a wide range of outcomes with returns negative in almost half of the past easing cycles. And that's because, as I said, it matters why the Fed is easing. If the Fed is easing because inflation is falling rather than because of an impending recession, then equities can hold up. And that's what we think will happen. So we have a relatively pro-risk stance. But the risk is that, it looks like we're getting a recession before we get that soft landing.
So, Skyler, what does it mean for asset allocation? Where do you want to be invested in early 2024?
So for us, the highlight for 2024 is obviously that we're at the start of the easing cycle. So all else equal, that's positive for equities and it's positive for bonds. Right now, there is quite a lot of easing price is the worry. So our expectation of a soft landing, while that means we have a pro-risk stance, easing cycles do tend to be bumpy for stocks. So we aren't massively overweight. We're cautiously pro-risk. At the same time, we like fixed income because of the carry, but the rally we've seen already does look quite exuberant. And if we don't get a recession, it does look quite a lot. So we're modestly underweight under government bonds, but we do like adding duration and credit. So total returns, we think, will benefit there from government bond rallies, but you'd also expect rallies on positive risk moves.
Great, thank you so much. Of course, Skyler Montgomery coding there from TS Lombard. Now let's also get more from the IFO Institute President Clemens Fuest on the figures that came out just minutes ago. December IFO business confidence, 86.4. That's a touch below estimates. Mr. Fuest, as always, thank you for joining us. How much do you worry about the German economy in 2024?
Yes, the situation is clearly weak. The economy is weak, and we've been waiting for a recovery now for some time, and it's not coming. So this is worrying. What's contributed to that is certainly the uncertainty surrounding the constitutional court ruling in Germany and the impact on the public budget. But there are other unresolved issues like high energy prices, frictions in international trade. So this is holding the German economy back.
But so do you believe the economy is actually slipping back? And so is the rebound that we were expecting at this time, is that further delayed?
It looks like it's further delayed. In our forecast, we expected a flat end of the year, so zero growth in the last quarter, and this may now tip us into another technical recession. Q3 was negative, and Q4 may now also be negative. So the recovery, if it comes, is certainly further delayed.
So do you think a recession in the second half is now confirmed?
Yeah, it's not confirmed, but it's becoming increasingly likely because we are just, we expected a zero, and now with this incoming data, it may very well be that we have a negative reading. Of course, this is all very close to zero. The bigger issue is that the German economy is stagnating more or less. Slightly above or below zero, but we are waiting for this recovery, which is not coming, and that is certainly a matter of concern.
But Mr. Fuest, you mentioned, of course, the German government finally agreeing on this budget after negotiations that at times we understand were pretty tense. The measures include subsidy cuts, but also they include a higher carbon price. So what's the impact of those measures actually on inflation and growth going forward?
So our expectation is that the impact on growth will be very limited, maybe 0.1 or 0.2 percentage points lower. That's not the big issue. The issue is maybe more the fact that there is a lot of uncertainty about economic policy going forward. And even now, the government has found a compromise on the cuts, but this compromise is now called into question again. So this uncertainty is just not going away. At the same time, what we would need is a convincing strategy, economic policy strategy, to get back to growth, a strategy for a recovery, and this strategy is missing completely. And I guess that is part of the story that explains why the German economy is not recovering. Of course, there are other factors. The global economy, global trade is relatively weak, so that doesn't help either.
How much of the German rebound is actually at the mercy of what happens in the U.S. and what happens in China?
The US and China are the most important export markets for the German economy. So what happens there is very important for Germany. At the same time, Germany faces some structural issues. So it's maybe less clear than in the past that an upswing in global trade will also benefit the German economy as it did before. So we have a combination of concerns about the global economy, maybe lacking dynamism coming from the outside, and domestic structural issues. If we think about the car industry, all the issues with e-mobility, autonomous driving, IoT problems. So it's this mixture of structural problems and weak demand from the outside.
But how much do you think the impact, I guess, of higher interest rates in Germany have already worked their way through the economy?
So higher interest rates have certainly had a strong impact on in construction. We have a very weak development. The IFO index has now reached its lowest level since 2005 in construction, and that also weighs on the German economy. It's high interest rates, but it's also high construction costs and complex planning procedures. This combination of factors is really toxic for the construction industry.
And Mr. Fuchs, this is not going to ease up anytime soon. When do you expect it to normalize a little bit?
Well, there are two factors that may help. First of all, wages are growing relatively quickly and employment is still strong. And then we do expect interest rates to decline maybe in the second half of 2024. And if the economy is weaker, this may even come earlier. So these may be two factors supporting the economy. And these are two factors that may help the economy to grow at least a little bit in the coming year.
Okay, Mr. Fuchs, thank you so much for joining us. Clemens Fuchs, there, the president of the IFO Institute. We'll have plenty more ahead on stocks, on central banks, and on the German economy. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
'23 looks like it's going to end up being a very substantial reduction in inflation without a big increase in the unemployment rate. That's the golden path that I talked about. But we're still above the target. We got to get inflation down to target before, until we're convinced that we're on path to that. It's an overstatement to be counting the chickens.
Well, Chicago Fed President Austin Goolsbee there speaking on CBS. Now let's continue our conversation with TS Lombard's head of macro strategy, Skyler Montgomery-Koenig, plus our very own Sofia Orta-Acosta. So thank you, Sofia, for joining us. Skyler, let's go back to something that we were talking about on central banks in general. And I know you have a note out talking about U.S. dollar strength and the fact that actually that in itself doesn't support a whole asset class. How do you see the U.S. dollar performing in 2024?
Yeah, absolutely. I mean, it's very interesting right now, right? Because momentum has clearly moved against the dollar. the Fed has come out as one of the most dovish G3s, and that's clearly weighing on the currency. But I think 2024 is a different story, and the strongest case for dollar upside is the strength in the economy, especially when you consider the economic backdrop of the major counterparts. Europe and the UK are in stagnation. Data in China is bottoming, but it's not providing a growth impulse. It's an L-shaped recovery. And China and the US are the two main global growth engines. So that means that with China not adding to growth, whether the US enters a recession or data bottoms, the US is the marginal provider of growth for the rest of GM, meaning we think US exceptionalism is likely to continue. And that economic divergence isn't reflected in policy expectations. I think, when people are doing their year ahead forecast, they really rely on dollar valuation as well as the dollar bull cycle. And that's told you to be long euro dollar for quite some time. But there are structural factors that have changed within the global economy that means that there's a reason for that overvaluation and that extended bull cycle.
And Sophia, I guess, and this is something that we were, trying to game theory with Skylar. It's basically the idea that central banks are likely to shift to easing monetary policy. The economy continues to slow, inflationary pressures remain subdued. What if we were wrong? Like, what are some of the forces that we should be looking out for early next year?
It's dangerous when you have kind of a really strong consensus in the market in either direction, right? And now you really have everyone kind of betting on that easing from the Fed a lot more aggressively than they were betting on a few months ago. But also the long yen trade. I mean, that's been a favorite play in the market for at least 3 years now, and it's always disappointed. And now there's so much conviction around that. Let's see if 2024 will actually be the year that actually works. That trade actually works. So I think the positioning is something to watch out for when there's so much kind of certainty amongst traders, these kind of one-way bets. And speaking of one-way bets, I do think the lesson for investors this year was China. There was a very, very one-way bet there at the beginning of the year, and we know how that's panned out. Again, disappointing returns there. So I think one key theme, Francine, is really kind of how do you hedge this going into next year if there's so much conviction that what everyone thinks is going to happen, this kind of central bank easing cycle, will happen at the same time and kind of easier and faster than people are expecting.
And Skylar, this goes back to something that again we were trying to look at. I asked about your global asset allocation, but also what do you do with unleveraged or leverage at the moment? It's kind of I don't know whether that's the main theme that we don't talk about for next year.
Yeah, it's quite hard, right, in terms of when you have interest rates pinging around, it affects what you do with leverage quite considerably. I think for us, when we think about next year, the main theme we're really focusing on as a risk is this idea that you could get a return of term premia in terms of we've had this roundabout move in term premia, and, it should be considerably higher than it is right now, as in term premia on the 10-year point is negative. And so a risk for us as we look into next year around all of these yield gyrations is that actually, curve steepening is amplified by the fact that you have to have a higher long end yield because of this term premium having to come back from being negative to something more around 100 basis points, or even, the average is more around 150 basis points. So that's something that I think is maybe underappreciated next year, is this risk that longer end yields, while you might get a rally still on Fed cuts, won't be they won't respond as much to easing as you will have seen in historic cycles.
And so, from that, basically, I guess you go from like region to region or country to country, which is why, you and your team are spending a lot of time trying to figure that out.
Yes, and again, don't forget about earnings, Fran, because we're talking about how markets respond to expectations of Fed easing, and we had a record high in the NASDAQ last week. But equity markets, they should kind of reflect what companies are doing on the ground, and there are some warnings. We're seeing some of this in the 2024 outlooks for next year, reminding investors to kind of like go back down to basics and look at how companies are faring, because the interest rate environment of this year, the higher interest rate environment this year, hasn't quite fed through to the real economy. So we could see some of that lagged pain. We are looking on the team, we look a lot at the UK. That's been a kind of unloved market for a very long time. I have bad news here for anyone who wants to be bullish on the UK. It doesn't look like it's still a very hard sell for investors, because even though you have cheap valuations, it's not an attractive market for a lot of money market, for a lot of funds.
I was going to say it is cheap, Skylar. So I don't know whether there are opportunities in the UK in certain parts of the market, or whether, Skylar, it's a type of market that you look at.
Yeah, absolutely. In terms of, for us, when we think about UK assets next year, really the dominant theme is still this kind of state of stagflation. So our leading indicators, they're hovering around 0, which is consistent with flat GDP for the year. PMIs, they're still deteriorating. The service sector is certainly slowing down. And what we're seeing is that the tightening cycle is biting. So the buffer of financial wealth in the UK is evaporated. That means there isn't protection as the effects of previous tightening start to feed through. And this is a gradual thing. Most mortgages in the UK are 2 to 5 years. So the banks started tightening at the end of 2021. So that's around 2 years ago. And so that will increasingly bite as homeowners are forced to get new mortgages. So the growth outlook isn't especially rosy. And that means that it's hard to be allocated in equities, but it does mean that fixed income in the UK is more appealing.
Okay, Skylar and Sophia, thank you so much for joining us. T.S. Lombard, Skylar Montgomery-Koenig, and Bloomberg's Sophia Horta-Acosta. Coming up, Israel's foreign minister dismisses appeals for truce as France, the UK, and Germany call for a sustainable ceasefire. That's next, and this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Israel is pushing back on intensifying calls for a ceasefire. That's after France, the UK, and Germany urged efforts towards halting the war as the civilian death toll mounts and tensions in the wider region continue to simmer. Well, joining us now is Bloomberg's Dana Krejci. Dana, will Netanyahu listen to these warnings from other countries?
So the EU is definitely upping the rhetoric for an immediate ceasefire, release of hostages. This comes after the U.S. last week warned Israel that it could be losing international support if it doesn't heed that warning, and also if it doesn't recognize that a two-state solution is the optimal solution to resolve this conflict indefinitely. There is no sign that Israel is going to stop or amend its operations on the ground in Gaza, or will heed to an immediate ceasefire call. Their aim is to eliminate Hamas, but what that means is not very clear. It also we don't know what it means in terms of what are the conditions that Hamas is effectively eliminated in Gaza. And the U.S. is asking or pushing Israel to do more surgical attacks in Gaza, as the death toll is nearing 19,000 in the span of 3 months now since the war started. But that could also be difficult, given that Gaza is heavily populated and Hamas's network is quite intricate underground.
Yeah, I mean, there's so much, the world, frankly, is turning, and I guess something will have to come to head. Is there anyone that Netanyahu would listen to?
This is hard to say. The calls have been mounting ever since we had the General Assembly call. We had a UN Security Council resolution, which was vetoed by the U.S., but still, it was quite a significant symbolic move internationally. Netanyahu is growing under pressure internationally and domestically as well. With the killing of the 3 hostages over the weekend, there is division internationally on how Israel is conducting this war, and also internally.
Dana, thank you so much for the update. Dana Krejci there. Now, coming up, the UK and Italy agreed to jointly fund migrant repatriations in Africa. We'll have the latest next.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Fed officials push back against bets of aggressive rate cuts next year, threatening a bumper global stock rally. Germany's IFO business confidence deteriorates in December, surprising economists and increasing the chances of a recession. And Israel dismisses a call by European leaders for a sustainable ceasefire in Gaza. Meanwhile, global shipping companies are on alert amid rising threats to containers in the Red Sea. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the UK and Italy have agreed to jointly finance migrant repatriations in Africa. The deal comes after Prime Ministers Sunak and Meloni met in Rome this weekend. Well, joining us now is Bloomberg's Alessandra Migliaccio in Rome. Alessandra, good morning. So illegal immigration has been a common issue for both of these leaders. What would this deal actually do?
Hello, thank you. Yes, well, the deal is indeed, it's about repatriation of migrants. Basically, people who are getting stuck in Tunisia, the idea is that the UK and Italy would pay for them to be repatriated so that they're not trapped there, so that they're not pushed to further try these extremely dangerous voyages to Italy, often by sea, where many of them unfortunately drown. And then, as we know, from Italy, they often move to Northern Europe, and they can get as far up as the UK. The thing is that, you know, we're being told this is very complicated. I mean, how is this actually going to work? Is it actually going to work? Because you're paying them to do what? To actually leave? You're actually making sure they get back to their countries? Or is it money that may be sort of lost in space, quote unquote, because you're not sure then what happens to these migrants and if they can actually come back and try again? But it's kind of a publicity stunt, many analysts are telling us, because it's just a way for Sunak and Meloni to show that they care about this issue, that they're trying to do something, they're trying to do something visible, a bit like the Rwanda plan for Sunak or the Albania plan for Meloni. And that is, I think, their main goal. Their main goal is to show they're trying to do something on migration.
But, I mean, this, again, was highly unusual because Sunak, it's not only that he showed up in Rome, he actually showed up at the party of Giorgia Meloni, who in the past has been controversial. Billionaire Elon Musk was also there, arguably the star attraction of the event. What did he have to say? And frankly, why was he there?
I mean, really, you're right, Francine, it was very weird. It's a win for Meloni because this is it was historically a right-wing party conference, and it wasn't very well attended, let's say, put it that way. And now suddenly you have Sunak, you have Musk showing up, you have some members of the opposition as well going. There was one member of the opposition speaking about LGBTQ rights. Musk was there. Basically, he spoke about demographics. He spoke about his concern that European nations are not having enough children, especially Italy. Italy is one of the nations that's having the fewest children right now in the world, particularly in Europe. And so he was very concerned about this. He says they're losing their identity, whatever that means. So it was really a strange mix of people coming together. I guess Sunak wants to show, you know, that he's doing something about migration, so he's moving a bit more to the right to get those right-wing votes. Meloni's trying actually to move more to the center and to show her legitimacy with all these people. Musk has his agenda. We're not quite sure what he's trying to do, but certainly it made Meloni look like she's at the center of the world stage. So I think a win for her, you know, regardless what it all means in the big picture.
So interesting. Thank you so much, Alessandra Migliaccio, there from our Rome bureau. Now, Vivendi has also begun legal action against Telecom Italia for its €22 billion landline network sale. Now, the French media giant, which is the Italian company's biggest shareholder, is challenging the decision to go ahead with the disposal of the asset. Now, Telecom Italia is planning to sell the network to U.S.-based investment firm KKR. And telecommunications company Iliad has submitted a proposal to merge its Italian operations with Vodafone. Now, the proposal is for the creation of a new entity where both parties would hold 50%. Under the proposal, Vodafone Italia would have enterprise valuation of just shy of €10.5 billion. Vodafone shares higher in early London trading. Now, Bloomberg has also learned that more Chinese agencies and government-backed firms have ordered staff to stop bringing iPhones and other foreign devices to work. Now, Apple's Asia suppliers are trading in the red this morning off the back of the news. For more, I'm joined by Bloomberg's Alex Webb. Alex, okay, there's a lot going on here, but basically, just how much has China ramped up efforts to ban iPhone in its agencies?
So what we'd heard in September was that around Beijing and Tianjin, there were a certain number of government agencies, also some big Chinese state-owned companies, such as PetroChina, had instructed employees not to buy iPhones, or bring iPhones to work, I should say. What the reporting now shows is there are 8 states, at least, and agencies and state-owned companies in those regions who are asking very much the same thing. That's a sort of bigger rollout of this strategy. The government is denying that this is a sort of a top-down edict, but there certainly seems to be a pattern emerging.
So why is China doing this exactly, and how far will they go? Is this like, does it really spell trouble for Apple?
So at this stage, it's not catastrophic for Apple. We've seen something similar maybe 6-7 years ago, where there was a sort of upsurge in nationalist fervor around buying Chinese devices, and that's when you saw companies like Oppo and Vivo come through, and Huawei itself. That did hit Apple's sales. They declined over the subsequent few years. They have recently been resurging, so it might take a bit of a dent out of that, but it won't necessarily be the actual bans that do it. It'll be more the kind of messaging about what owning a foreign-made device, well, not necessarily foreign-made, but a foreign brand device like Apple or indeed Samsung could mean. So that would be the pain amidst all of this. There is greater emphasis being placed on Huawei, which has been the subject of US export controls. They released a device in August, which was a lot more advanced than the US thought was possible. So there is an greater emphasis being placed on those homegrown manufacturers.
So, I mean, is the ban actually feasible? Like, what can replace an Apple?
The challenge for China isn't necessarily that they couldn't ban them, that they could. It's more that Apple employs directly and indirectly millions of people in China to make their devices, and so you would there's a risk here that you'd be cutting off your nose to spite your face to a certain degree. There's a symbiotic relationship to a great extent between Apple and China. Doesn't mean it's completely impossible, but it would seem highly unlikely.
All right, Alex, always on the best stories. We'll have plenty more, of course, on this story with Alex Webb throughout the day. Now, in Hong Kong, former media mogul Jimmy Lai is facing charges in the city's highest-profile national security case. Lai is essentially standing trial for acts of self-expression that are once openly permitted in the former British colony. Now, the U.S. and the U.K. have called on Hong Kong to release a 76-year-old, condemning the prosecution. China has hit back, describing the remarks as blatant political maneuvering. Well, Bloomberg's Rebecca Chun-Wilkins has more.
We are here outside West Kowloon Magistrates Court on day 1 of what is going to be a landmark trial for Hong Kong. Jimmy Lai facing national security and other sedition charges. Now, it's really significant for the city because the critics have said that the proceedings undermine the rule of law that has for so long underpinned the success of Hong Kong as a financial center. The other thing that will be closely scrutinized is the condition of Lai himself. There have been very, very few public images made available of him, but in the last one he appeared to be thinner. And Lai's own family have warned about some of the health conditions that he is suffering. And the third big element is the question of geopolitics here, and whether or not this becomes a flashpoint, particularly for US relations with China and the UK's relations with China too. We already had a statement from the US calling for the immediate release of Jimmy Lai.
Now, coming up, we'll be joined by Tom Atheron, the chief executive of London store Fortnum & Mason, as we take a look at how consumer spending is doing this festive season. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Now, predictions for consumer spending this holiday season remain downbeat. UK retail sales have struggled in the run-up to Christmas, and that trend is set to continue when we get the latest data this week. Now, according to the Center of Economics and Business Research, people are spending more, but ending up with less. Now, for more on what the UK retail sector is looking like this festive season, I'm joined by Tom Athorn, the Chief Executive of Fortnum and Mason. Thank you so much for joining us, Tom. I mean, you're a little bit different, right, to retail, because it's really about Christmas. I don't know how much you make in terms of sales for the year, but I imagine it's like 60%, because you think Christmas, you think Fortnum. How are sales doing?
So thanks for having me. Nice to see you, Francine. Christmas is hugely important to us, as you'd expect. And actually, after a sort of relatively slow start, I would say, October and November were probably a bit more muted. What we've seen over December is a real ramp-up in interest for people shopping, certainly at Fortnum's, both in-store and online. So we're pleased with the way things are going so far.
And are they buying the same things as they were last year? Are they trading up? Are they buying fewer but more expensive, or less but cheaper?
They're definitely being more cautious and more thoughtful in the way that they spend their money. I think when times are tough, for all the reasons that we understand, people do spend a bit more time to think about what they want to buy and where they want to spend their money. And I think Fortnum's, which is actually a business that attracts a very, very broad demographic, not just international tourists, but also a big domestic business, can attract people who are just looking for that small moment of joy. And I think that we're quite good at providing that.
But is it tourists that are coming? I mean, again, if you can break down kind of like what you've seen so far. Now, you keep on hearing that there could be also a very late surge in Christmas spending.
So very late surge in Christmas spending. It's not so much tourists at this time of year. It tends to be a more domestic audience, actually. We see a much more international trade over the course of the summer, when London is a very attractive place for people to visit. But at Christmas, it tends to be much more domestic consumers shopping for something special.
So is it worse than last year, or is it too soon to say?
No, it's better than last year, I would say. But as I said, quite muted over the course of October and November. And then I think once Black Friday was out of the way, people suddenly thought, I need to go and shop. And I think that what they're looking for is something small and special, so they might not have spent as much money as last year, but they come to places like Fortnum's where they can get, a jar of jam, their sort of their entry into luxury for a relatively small amount of money. But of course, it's the world's best jam, and that's why they come to us.
Of course, no advertising here. Don't try any other jam. Can you give us a sense of why do you think that actually people are spending a little bit later, or going to the shops a bit later? We had supply chain issues last year. I don't know whether that kept people off the streets, or we had the strikes last year.
Yes, we did. So the train strikes make a big difference every time, and I was really disheartened to hear that they were starting train strikes again a couple of weeks ago. That actually didn't seem to have too much of an effect this year, which was really good. I do think people are spending later because they're just being more careful about what and where they spend their money and what on. And I think, the days of just going out and spending a lot of money having a fantastic Christmas, I think are much more muted this year, and people are just being much more thoughtful. But it's good to see that the train strikes aren't there. The supply chain issues aren't there this year. We haven't had those really significant winter storms over Black Friday, which means that the courier businesses can never catch up if they get behind at that point. So it's felt like it's much more organised and much more stable this year, and it's good to see. But also, people are coming back into shops as well. I think what happened over COVID was that people were saying that it was the end of shopping and everything was going to go online. And I think what we've seen over the last couple of years is the resurgence in shopping in real life, which, of course, is what Fortnum's is all about.
But this is also because of the Christmas lights lights because it's festive. I imagine it's different during the Christmas holiday period to other parts of the year.
It is, although, I mean, our strategy is to become more relevant to more people more often, and that means all the way through the year. So those key gifting moments, Valentine's Day, Mother's Day, Easter, summer picnic, all of those things are hugely important to us. And actually, as a result, we're now profitable pretty much all the way through the year, whereas I think historically it was a business that was just profitable at Christmas. But Christmas is done really well at Fortnum's. The lights in front of the building attract crowd across the street who are waiting for the clocks to chime. We have turned the front of our building into an advent calendar. So the lights...
we were just showing that on TV.
Up, which is just fantastic. So it's a real spectacle, actually, and we are hugely proud of the creativity. The other thing that's been a real hit this year, and is, I think something that I've really noticed, there you go, there's the front of the shop now. The other thing that I've really noticed is the power of social media. And in order to get that Instagram moment, you need movement and you need sound. We have some dancing Christmas puddings going up and down in our atrium.
As one does.
Which are stunning, with music provided by Fortnum's own staff who are singing Christmas music in the background. And of course, these days for social media, people don't take pictures, they take video. And so you need movement and you need sound. And I think that's really resonated this year.
So what do you sell the most of, apart from the jam? Do you have like one bestseller, blockbuster?
So our Merry Losses biscuits sell really well. They're $19.95. They're an amazing biscuit. They're sort of a milk chocolate with fruits and spices. Our hampers obviously sell. That's our iconic product. We've been selling hampers for hundreds of years. And we'll sell the best part of 300,000 hampers this year to people all over the world.
I mean, as you sat down, I was joking that I have a candle in the background right here behind me, and you said actually Fortnum started as selling candles, which I had no idea.
It did. It was founded by Mr. Fortnum, who was a footman to Queen Anne, who asked for permission to take the melted down candles from the court at St. James's Palace, remelt the beeswax into new candles and sell them from the site that we now trade on Piccadilly, and that was in 1707, so that's 316 years ago.
And do we buy more candles and we do other things now? I mean, I guess, you always have to stay on top of trends.
Yes.
And so I don't know whether the jam has less sugar now, that we're a little bit more careful on what we eat.
Yes.
And things like that.
So we definitely have to think about that. We don't just sell candles anymore. Obviously, we're a business that's now centred on extraordinary food and drink. But to give you an idea of the latest sort of thing that we've been seeing, we started distilling gin on site on our third floor. We've opened a gin still. It's called a Malthea. And actually, our pink gin has become one of our best-selling products literally overnight. It's been a great success.
And how much do you sell abroad?
About 20 or 25% of our sales go abroad. We've just relaunched deliveries into the EU post-Brexit, which has been a real headache for us. Our EU customers were very keen to access products in market. We've just found a way of redelivering hampers and products to them over the course of the last couple of months. And I really think that that's a business that's going to grow next year. And then the US as well is a big opportunity.
But so for the EU, this was a problem of what, tariffs, taxes, or just the time it took so to get them?
It's the administrative burden of shipping food into the EU because of the regulations around food. But we found a way of opening our own distribution centre in Belgium, and we export effectively to ourselves, and then what we do is we sell that product on from there to our EU customers through a dedicated EU website.
I know a lot of retailers have especially the higher end, has said, look, the government needs to do something about VAT. I mean, have you seen a drop, or does it not really apply to...
I mean, our effective VAT rate's relatively low because, of course, we're a food business.
Yeah.
But yes, I do think there's probably a case to be argued for changing the rules back, and so VAT refunds are available to our overseas tourists. I do think that effect has been somewhat masked by the relative weakness of sterling, which makes Britain a very attractive place for overseas visitors. And I suspect that's only going to get worse as the Paris Olympics start to hit next year, where the rest of Europe will become more attractive. So I do think there's a case to answer on that, yes.
Okay, so interesting. Tom Athearn, thank you so much for joining us. The busiest man in the festive season, Tom and Santa Claus. He is, of course, Chief Executive of Fortnum & Mason. Coming up, we look back at 2023, a period of inflation, rate debates, and difficult geopolitics. What has this meant for stocks as we near the end of the year? We'll discuss that next, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back. Now halfway through Jamie Dimon's special incentive to stay 5 more years at the top of JP Morgan, the bank's succession plan still appears unclear. Bloomberg's Sue Keenan has the details.
Jamie Dimon is viewed as a fiery CEO who's not going anywhere anytime soon. In fact, he's famous for avoiding questions about retirement or succession, and he made it clear back in 2009 he thought it was in his best interest to avoid such questions, which he referred to as drama. But that hasn't stopped speculation within the bank about who the frontrunners to succeed him might be. A management shuffle in mid-2021 put 2 co-heads of the Consumer and Community Bank Division in the spotlight, just as the bank gave Dimon a big bonus to stay on another 5 years. Marianne Lake and Jennifer Piepsack are widely seen as frontrunners or top contenders, although the insiders say neither is the clear frontrunner, nor have they vied for the top job. The insiders are predicting more senior leadership changes or reshuffling might be needed to give these contenders more experience to run the whole company. At the same time, JP Morgan Chase is more profitable than ever under Dimon, who's been there for 18 years. The stock is up 23% year to date and hit a high for the year on Friday. Sue Keenan, New York, for Bloomberg.
Now, it's been a year of inflation, rate debates, job cuts, geopolitical tensions, and of course, war. So what has it all meant for business? What has it all meant for the economy and therefore equities in 2023? And what's in store for next year? Well, joining us now is our very own expert, Tim Craighead from Bloomberg Intelligence. Tim, I mean, really, 2023 has been a very difficult year. So what surprised you the most, and what does it mean for next year?
Yeah, I tell you, I think one of the biggest surprises to us has been the earnings resilience across European markets. If you look this year, or if you look over a 2-year period to sort of take into consideration 2022's craziness, Europe's earnings have actually far outperformed the U.S. You wouldn't necessarily think of it that way, but earnings here, if you look at the core Euro stocks, are up about 21% over 2 years. U.S. is up 8%. So that's a surprise. Looking into next year, however, we're starting to see some negative revisions in Europe. U.S. is ticking up, so that earnings performance picture looks set, at least for the first half, to shift away from Europe.
But Tim, so if you look at valuations, Europe is still definitely, still depressed compared to the rest of the world.
Yes. Well, there's no doubt, and part of that is simply composition that's not going to go away. We're heavy on financials, we're heavy on energy and materials. It's especially true with a market like the UK, where we also have a lack of the US's, TMT. We don't have the Magnificent Seven over here. And so that valuation difference, just in composition, is roughly half of the variance between Europe and the US. The other element is what's going on with central bank policy, inflation expectations, interest rates. And if you look where we are right now at 13 times forward earnings for Europe, we need a significant change in interest rates to get it much further ahead. And that really is what it boils down to.
So if you look at the underlying drivers, if you look at China, the stalled recovery, how does that play into your thinking?
I tell you, China looms large for Europe. I think we may have chatted about this back a month or so ago. It's over 450 billion euros of revenue exposure across a top group of European companies that aggregate to almost a third of the index. Think metals and mining here in the UK, think autos in Germany, think luxury goods, etc. First half of 2024 is a difficult comparison. So that's the bad news. The good news is they have their plenum coming up in January that usually is economically oriented as the third plenum. If they pull the stops out, which has been disappointing so far from the standpoint of policy initiatives, we could see a revival as we get into next year, as we look towards 2025. So think first half, second half for China.
Tim, thank you so much. Tim Craighead from Bloomberg Intelligence. Now, up next, Bloomberg Brief. Tom McKenzie is here in London, and this is Bloomberg.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Good morning from our studios in London. I'm Tom McKenzie in for Danny Berger and Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Fed officials push back against bets of aggressive rate cuts next year. Austin Goolsbee says it is too early to declare victory over inflation. Global shipping companies are on alert amid rising threats to containers in the Red Sea. We speak exclusively with the CEO of Frontline, one of the world's biggest crude shipping companies. And China's iPhone ban ramps up with more staff said to be barred from bringing foreign mobile devices into the office. Let's check in on the markets then. This Monday morning, we had the pushback from those Fed officials just days, of course, after the dot plot of the Fed suggested 75 basis points of cuts in 2024. To what extent is the market believing this pushback, and where does the focus land when it comes to the data picture? More data, of course, out from the US later this week. Crucially, well, for the Fed, the PCE indicator on Friday. US 10-year yields then, you're seeing a move of 3, almost 4 basis points lower. So you're seeing a bid across the Treasury curve. Despite this pushback from some of these Fed officials, you are seeing yields lowest across the curve, most prominently at the front end. Yes, just 3-4 basis points at 440 on the 2-year. The 10-year, by the way, for context, 389. Yields down just 1 basis point. In terms of euro dollar, you are seeing strength for the single currency, despite the sentiment gauge out of Germany pointing to weakness once again for that economy. Put that on top of the PMI data that came through last week. Manufacturing and services both firmly in contraction in Germany, but nonetheless, the single currency is up 0.2% today at 109. Brent crude, this is in focus for us today, given the geopolitics and the challenges around the Red Sea. We have seen prices up at the beginning of the session. You're now down by 0.6%. You did see that strength coming through from oil last week. The first week of gains for a number of weeks for oil prices. But, of course, the action coming through from the US and particularly shale, the production there is strong. And there continue to be, of course, question marks around demand out of countries like China. Currently down 0.6% on Brent, $70 a barrel on WTI, down 0.8%. A couple of equities to bring to your attention, individual corporates worth flagging this morning. OCI listed over the Netherlands. This is a deal that's come to the fore with Koch Industries, the company coming to a deal with Koch Industries to sell part of its business in Iowa, valued at around $3.6 billion US. So OCI, one of the biggest gainers so far in the session today, up, as you can see, almost 14%. Then we continue to focus on the shipping companies amid the concerns about access to the Red Sea and through the Red Sea, as some of these shipping companies divert their carriers to other routes and extend the passage. Is this an inflationary impulse that maybe the markets are overlooking? Currently, those stocks, or that particular stock, Hapag, they're listed, of course, gaining a little over 2%, a little under 2%. And then ST Micro, this is the tech story of the day. Further developments in terms of China restricting the sale of Apple products, and particularly the smartphones, in certain parts of that country, certain companies, certain regions, certain government bodies as well, restricting the ability for employees to bring those devices into work. And you're seeing a little bit of pressure coming through for ST Micro, which is a supplier, amongst many others, of course, to Apple. Just down 0.8% so far in the session. Let's get back to the macro then, and a growing chorus of Fed officials are pushing back on markets' enthusiasm over when rate cuts will begin. Chicago Fed President Austin Goolsbee joined in.
2023 looks like it's going to end up being a very substantial reduction in inflation without a big increase in the unemployment rate. That's the golden path that I talked about. But we're still above the target. We got to get inflation down to target. We made a lot of progress in 2023, but I still caution everybody, it's not done. And so the data is going to drive what's going to happen to rates. For sure, it's too early to declare victory.
Okay, joining us now for the take then is Kit Jukes, Chief FX Strategist at SocGen. Kit, what do you make of this pushback then from some Fed officials over the last 48 hours? What does it tell us about guidance from the Fed?
Well, I mean, so the first piece is obviously the dot plot told us that 3, so we priced in 6. So there's an element of that'll serve you right for putting over. I think it's difficult to have this much guidance, sort of over guidance, and a dot plot. I mean, so I don't know if it's going to die at some point because you don't have control of the narrative if everybody puts their dot where they want it, and then you just kind of take the result. So they feel, but otherwise, we were all surprised by how dovish they sounded, and particularly actually how dovish the chairman sounded last week, and thinking, do they know something we don't? Followed by, we've had nothing but good, better economic data for longer than almost anyone had expected. And then markets went fairly crazy. But if they want to control the narrative as tightly as they seem to, they might have to lose the dot plot.
Okay, well, where do you land? Talking the dot plot, I mean, you kind of rolled your eyes at the idea that we could get 6 cuts next year, and the markets have walked that back to some extent, but they're not at the 3 that the dot plot is. But where do you land on expectations?
6. You do land our US economist, Stephen Gallagher, has thought for a really long time that there would be a mild recession in the middle of next year. It was in Q1, his forecast, but a year ago. So he's been pretty sort of stuck with the same view. So I sit there and think, yeah, okay. The answer is, though, I mean, you could say it any time, is we understand the dilemma for a forecaster of the US economy that there's this large pile of fiscally financed savings sitting in bank accounts that's being whittled away. And when it runs out, all these service sector jobs that have been there in particular, as people go out and spend money, are going to be in danger. The manufacturing sector is already pretty much in recession. And trying to guess the day, I think it's a mistake to say there won't be a mild recession when this runs out. But it's right to say this has not run out yet. It's going fine so far. And anybody who was sure it was happening earlier is definitely been wrong. But I find that the challenge for next year is you can't say there isn't going to be a recession.
Okay, and you have to watch the cash buffer of households to get a sense as to when that pain really comes through in terms of the US economy. Well, how are you thinking about the dollar then? What is the biggest pull factor? Is it those 6 cuts, or however many it ends up being? Is it a Fed that is cutting rates, or is it the relative resilience of the US economy versus counterparts and that haven move?
I think the first thing that is a challenge is this is the biggest dollar rally since the early 1980s. And in 1986, for those who can't remember, 85, 86, the dollar went down for miles. There wasn't a recession. They didn't even cut rates that aggressively in that period. So there's part of me that thinks, a lot of people got very bullish of the dollar. It went up a long way. Gravity does some of the work, overall. And then we'll have to see how weak the economy is, and particularly how much they do cut rates as they slow down, because it's been held up by rates. The near-term challenge is the other side of it, which is, the PMI numbers in Germany, the IFO numbers in Germany, all of which say to anybody listening to the ECB, I get the plan, but every plan has to run into the economy at some point.
It's starting to look a little bit more hollow, isn't it? The insistence that we're going to go higher for longer. We're not even thinking about cuts. 109 on the single currency. It's up 0.2% today. What is the next level? What's the next range that you're looking for euro dollar then?
Well, we've failed to get through 110 in a convincing fashion after the FOMC and then after the ECB. So we had 2 goes up through there. I think we'll eventually get there, because I think the market is so pessimistic about European growth, and the numbers are so bad that they're more likely to be improving through Q1, Q2. But I have a forecast for the end of next year at 116, which, frankly, that's another whatever it is, 7 figures from here. We've done that much in the last few weeks almost. So I think it's going to be a slow grind for the euro. It ends up, again, it's been pretty beaten up. There's a lot of negativity. I don't think the economy's as bad as some of the opinions. If you plotted Bloomberg consensus forecasts for Eurozone economy next year in the US has gone up and up in recent months. Europe's gone down and down. I'm not sure I want to jump on that divide going wider and wider forever. But right now, Euro bull gets no help from the data.
Okay, and you're looking at 115, you said, into next year for euro dollar, so a little bit more weakness to come through, currently at 109. When it comes to the Japanese yen, the BOJ is in focus, of course, for us this week. The meeting is tomorrow, the decision is tomorrow. Is the Japanese yen looking a little overbought at this point?
I think it's vulnerable, and we saw from the positioning data that came out at the weekend, the market has finally taken a hunk of its yen short off. The speculative market appears to have been significantly short since 2021. So there has been, when we were at 110. So there's been some money made being short the yen. I think this is short covering rather than people getting overexcited. But yeah, I haven't heard of a Japanese economist who thinks they're doing anything tomorrow. Obviously, when you've not done something for so long, it's going to be a surprise on the day it happens, but this would be an odd week to bring such a big surprise. So yes, I think we'll get, the danger is dollar-yen bounces. The danger after that is that that's an opportunity for people who think, well, they are going to go sometime soon. Maybe after my, whatever that is, 2 years of being short this currency, I should take my money and go and sit on a beach.
That sounds like a nice prospect in the current climate. 142 currently on the yen, down 0.3% in the session today. We have the meeting, of course, from BOJ tomorrow. The Bloomberg survey is that most likely you get an end to negative rates in about April. SocGen's Kit Jukes, thank you very much, as always, for the analysis and the calls on these currencies. Now to some other top stories that are trending on the terminal this morning. A former advisor to the PBOC, talking to central bank, says China should gradually reduce its holdings of treasuries and balance trade by boosting imports to control its exposure to US debt risks. He says the appeal of American debt to other nations is waning. Republican leader Mitch McConnell says hurdles remain in Senate negotiations on US-Mexico border restrictions demanded by his party in exchange for clearing assistance to Ukraine and other US allies. The outlook for a vote this week is uncertain. FTX unveiled its latest proposal for returning billions of dollars to customers and creditors. The proposal kicks off a final round of potential squabbles about how best to end the bankruptcy case of the fraud-tainted crypto firm. And halfway through Jamie Dimon's special incentive to stay 5 more years at the top of JP Morgan, the bank's succession plan still appears unclear. Bloomberg's Sue Keenan has the details.
Jamie Dimon is viewed as a fiery CEO who's not going anywhere anytime soon. In fact, he's famous for avoiding questions about retirement or succession, and he made it clear back in 2009 he thought it was in his best interest to avoid such questions, which he referred to as drama. But that hasn't stopped speculation within the bank about who the frontrunners to succeed him might be. A management shuffle in mid-2021 put 2 co-heads of the Consumer and Community Bank division in the spotlight, just as the bank gave Dimon a big bonus to stay on another 5 years. Marianne Lake and Jennifer Piepzak are widely seen as frontrunners or top contenders, although the insiders say neither is the clear frontrunner, nor have they vied for the top job. The insiders are predicting more senior leadership changes or reshuffling might be needed to give these contenders more experience to run the whole company. At the same time, JP Morgan Chase is more profitable than ever under Dimon, who's been there for 18 years. The stock is up 23% year to date. It hit a high for the year on Friday. Sue Keenan, New York, for Bloomberg.
Okay, coming up, China's iPhone ban continues to spread to more government agencies and state-backed firms. We're going to discuss the impact next. And later in the hour, our exclusive interview with Lars Barstad, the CEO of shipping company Frontline, on the disruptions we are seeing in the Red Sea. Stay with us for those conversations. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will
this be the last of its kind? No. This is the nature of capitalism. Get over it.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Welcome back. This is Bloomberg Brief. I'm Tom McKenzie in London, standing in for Danny Berger and Manus Cranny. Now to China and Apple. China ramping up its ban on iPhones across government agencies and state firms as the nation instructs employees to stop bringing foreign devices to work. For more, let's bring in Bloomberg's Alex Webb, who, of course, has been looking at this story for us in detail and has followed the travails of Apple in China, the upside and the downside, for a long time. Talk to us about the significance of this. We've reported on the start of this kind of process, and it seems to be spreading in China. And the context is, of course, that these agencies and these SOEs, these state-owned enterprises, employ tens of millions of people.
Yeah, so what we had initially heard is that there were a few agencies and state-owned companies, not least PetroChina, which itself alone employs several million people, that had issued this sort of edict. Now the reporting is showing that there are 8 states where this is happening. The government has been saying, well, this is not a top-down edict, but at the same time, the mood music doesn't sound terribly good. The significance of it really for Apple, it clearly isn't good news for them. In and of itself, those agencies, they're probably not going to be taking massive chunks out of Apple's sales in China. But it's about what it says about Chinese mood towards Apple. We saw this, perhaps when you were back in China 6-7 years ago, that there was a certain pushback on foreign branded devices, if not quite foreign made, and we saw a resurgence in the brands like Oppo, Vivo, and Huawei. Since then, the past 2-3 years, since the pandemic, Apple's really recovered and is back to growth in China. This kind of begs the question, well, maybe actually, if that's what the kind of messaging is from the top in China, that you shouldn't be having foreign-owned devices, then you'll see a resurgence in that nationalism. You saw it a little bit already with Huawei when they released their new device in August, and that starts to chip away at Apple sales.
Yeah, and arguably that would have been a harder message, the nationalistic play a few years ago when maybe the quality of domestically produced or at least domestically designed devices were just not up there, not up to scratch with Apple. But now that has changed and you have real competitors. How is that part of the timing, why China is doing this now, and the impact that this will have ultimately longer term, you think, on Apple?
I mean, look, the Apple thing is unique, right? Because Apple and China's relationship is pretty symbiotic. Apple employs directly and indirectly millions of people in China to manufacture its devices for the global market. So it's quite hard for China to really, say, impose a full ban on Apple without having a massively deleterious effect on its own workforce. At the same time, you have seen bans on Huawei devices in the US, and of course, companies like ZTE. The mood music from the US, in turn, is not brilliant towards China. So it does look at times as though China is looking for ways to put a bit of pressure on the US counterparts. There have been some US chip makers, particularly in the memory space, which have not got as good access to the Chinese market as they used to. It is sometimes harder for China to do that because they're pretty dependent on a lot of US tech to make the bleeding edge stuff. Even though Chinese devices have caught up to an extent, there is still a big lag. They've got below 7 nanometers, which is, quite close to the bleeding edge in semiconductors in the latest Huawei phone. Don't forget, the new Apple devices are sub 3 nanometers. So there's crossing that delta is not easy, but the gap isn't as small as the US thought it was.
You absolutely do see that nationalistic tilt in China, but sometimes I think it's overplayed because I'll never forget the lines and the queues outside these Apple stores, whether it's in Beijing or Shanghai. That demand. People in China love Apple products broadly. They do have more choice, more optionality now.
Yeah, I mean, look, I take that with a pinch of salt because these days Apple does most of its sales online, and so the queues around the block are kind of, they're not always terribly indicative, and Apple, it does have quite a lot of stores in China now, but nowhere near the sort of penetration that it has in the US. I mean, if you look at the numbers, right, back in 2015, Apple had about just short of $60 billion of sales in China. That declined all the way through to 2020, where it got to $40 billion. So they lost lost almost $20 billion worth of sales. Since then, the past 2-3 years, it's jumped again, almost doubled, right? So that's where we're looking to see if there's a fall-off.
Okay, really interesting. Bloomberg's Alex Webb on the implications for Apple and the broader smartphone market as a result of these increased restrictions coming through from China, at least at the local government and state-owned enterprise level. Alex, thank you. Let's check in on the bond markets then as we reflect on the pushback that's been coming through from these Fed officials, but also data out of Germany pointing to weaker sentiment once again on the German economy. You haven't got a lot of movement on the German 10-year. The yield is currently just above that 2% level. On the 10-year, though, you are actually seeing US Treasuries bid modestly, but you are seeing yields down between 1 and 3 basis points, 3 basis points lower on the 2-year. Intraday, UK 10-year, 365, yields lower by 3 basis points. Plenty more coming up. Stay with us. This is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. You know, we will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment cases for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Oak Hill Advisors CEO Glenn August predicts the private credit market will triple in the future. August spoke on Wall Street Week with David Weston.
When we look at the private credit market today, the opportunity to invest in the first 0 to 40% of a capital structure, 0 to 45, maybe 50% sometimes, in a multi-billion-dollar company, in an industry we like, with management team we like, with sponsorship we like, and the opportunity to make 10, 11% plus unlevered is really attractive. So I think it's this combination where the market's not providing the capital, the issuers want that capital, and then, by the way, if you think about this impending $1 trillion of debt plus it's coming due, there are going to be many companies that are not stressed and distressed but are actually performing, and they're going to want to access that market too. And then one last thing is a lot of transactions done in the last few years were really platforms and then build-ups. So a private equity sponsor would buy into a business. They'd pay a pretty full valuation with an expectation they could do some consolidating transactions at a lower price. Well, because rates have gone up, because the business has been a little softer, they don't have that free cash flow, and so the opportunity to do offensive private capital transactions to support that M&A activity, I think is really attractive.
So how big could private credit get in your adjustment?
Well,
because to put it in perspective, there were numbers coming out of Apollo, actually, that said it's like $1.5 trillion, something like that, in private credit. The balance sheets of the banks are $100 trillion. Right. So it's come up a long way, but comparatively, it's still relatively modest.
But let's put that in context. The leverage finance market today, the leverage loan and high yield market today is about $3 trillion. That's the liquid market in the U.S. The private credit market today, $1.5 trillion. If you look at the likely demand for private credit, if you take the $2.4 trillion of dry powder in private equity funds, and you assume $5+ billion of deals, there's an enormous demand for private credit. And then when you think about the refinancing, there's about $600 billion of debt coming due that's rated B3 or below that will probably have to access the private credit market. And so you can see the private credit market tripling. And I would say that if it gets to $5 trillion, that's a pretty large market.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Welcome back to Bloomberg Brief. I'm Tom McKenzie in London, in for Danny Berger and Manus Cranny. Here's what you need to know. Fed officials push back against bets of aggressive rate cuts next year. Austin Goolsbee says it is too early to declare victory over inflation. Global shipping companies are on alert amid rising threats to containers in the Red Sea. We will be speaking exclusively with the CEO of Frontline, one of the world's biggest crude shipping companies, in just the next couple of minutes. And China's iPhone ban ramps up, with more staff said to be barred from bringing foreign mobile devices into the office. Let's check in on these markets. You're seeing European stocks currently flat across the benchmark so far in the session. In the yield space, though, despite this pushback from some Fed officials trying to reshape the narrative around the extensive cuts expected for 2024, well, money is again moving back into US Treasuries. Yields down 3 basis points at the front end on the 2-year at 4.41. The 10-year, for context, 3.89. Yields down between 1 and 2 basis points. There is money moving in to sovereign debt so far this morning. It's modest, but it's again in focus for us. Euro dollar currently up 0.2%, despite softer sentiment surveys coming out of Germany. 109 on the single currency. And in terms of the oil markets, this in focus for us as we look at the Red Sea and the ruptures there, with some shipping companies diverting some of their carriers away from that region because of these attacks that we have seen from Iran-backed Houthi rebels. Brent crude currently down 0.8% after being higher to start the session here in London. We keep across the oil story as well. We know that the output has increased as well from US shale, but front and center for us right now is the geopolitics, the impacts on that energy space. $75 a barrel on Brent. Let's stay on the geopolitical story then, and we're going to talk about how that is evolving. But before I get there, a couple of corporate stories to bring to your attention as well. There's a deal in the offing for the Dutch-listed OCI fertilizer company. It will be selling some of its US assets in Iowa to Koch Industries. And that stock is the leading stock across the European session so far this Monday, gaining almost 15%. Valued, that business in the US, at around $3.6 billion US dollars. We have the shipping companies in focus for us today. Again, on the back of that geopolitical story, you can see Hapag-Lloyd, currently one of the companies that we pulled out for. You could also look at Immerse as well, gaining that company currently 4%. And in the tech space, ST Micro, the French maker of semiconductor equipment and a supplier to Apple, down 0.7%. The news, of course, that Apple is further restricting sales, or at least the ability for staff or employees of big state-owned enterprises to bring in Apple products. So there's concerns about the impact, more broader impact of Apple products and demand there in the Chinese market. This is one supplier in the European space to that company, currently down 0.7%. So on the geopolitical story, as I flagged, Israel, Hamas, that war persisting, of course, almost 3 months into this now. Diplomats from France, Germany and the UK, well, they have all called for a ceasefire. However, Israel is pushing back, saying that ending the fight would be a, quote, prize for terrorism. Joining us now is Bloomberg's Elisa Odenheimer. Elisa, why is Israel then rejecting the calls for a ceasefire from the UK, from France, from Germany?
Yeah, hi. I think that we have to start with the October 7th attack, which was so brutal, in which not only 1,200 people were killed, but many were tortured, raped, including children and babies. So at this point, Israel set out 3 goals. One is to eliminate Hamas, make sure that Hamas can never do this again, because Hamas has already said, its leaders have already said, we're going to do this again and again and again. So the first goal is to get rid of Hamas. Second goal is to bring the hostages back. In that attack, Hamas took 240 hostages, and there's still about 130 left inside Gaza. And the third goal was to make sure that there would never be a group in Gaza that could threaten Israel again. Now, the people who live in the communities near the Gaza border have been evacuated from there, and they will refuse to go back unless Hamas is gone. So if a ceasefire is enacted, then none of these goals will be realized. Now, besides that, Israeli officials have said that they feel that if Hamas is allowed to get away with the attack, with the October 7th attack, then other groups, for example, Hezbollah, which is in Lebanon and on Israel's northern border, will also feel free to make the same kind of attack. And in fact, they have been attacking Israel since October 7th.
Yeah, indeed, and Hezbollah, on many counts, and from the view of many experts looking at the region, more dangerous a foe potentially than Hamas, particularly in terms of the extent of its missile stockpiles. When it comes to these Houthi rebels that, of course, are targeting now shipping in the Red Sea, we know they're backed by Iran as well. Alyssa, why has Israel so far refrained from responding to those attacks?
Right. The Houthis have attacked Israel both by sending missiles towards Israel, and also by attacking any ships that they say are somewhat connected to Israel, either through ownership or because they're planning to stop at an Israeli port. And thus far, what Israeli officials have said is that they believe that this problem is an international problem and that the global community should get together to stop the Houthis. Now, they've also said that if this isn't done, then they will be forced to respond. But I think that Israeli officials would very much like to avoid having a third front. In addition to Hamas and Hezbollah, also the Houthis. That's a bit much.
Okay, excellent context. Alyssa Oldenheimer, thank you very much on the latest in terms of those calls for a ceasefire from Israel as it pursues, of course, that conflict with Gaza and the further geopolitical ramifications around the Red Sea, a story that we're going to revisit just in the next couple of minutes. Before we get there, though, a redhead crossing the terminal, very different story, so we're switching focus, because this is around a corporate deal in the steel space. The redhead, Nippon Steel, to acquire United States Steel. This is according to reports from the Japanese newspaper Nikkei. This is a 1 trillion yen deal. According to the reporting, Nippon Steel seen paying over 1 trillion yen for US steel, and you can see US steel pre-market rallying a little over 5% on the back of these lines that are crossing. We will bring you more context when and if we get it on this deal, but as you can see, US steel moving on the back of this news. Reports coming through from Nikkei. Let's get back to the geopolitical story of the moment then, and these carriers that are now diverting, at least some of them, around the Red Sea. Joining us exclusively now for more on the tensions in that area is Lars Bastad. He's the CEO of Frontline. It is one of the world's biggest crude shipping companies. Lars, thank you very much for joining us this morning. What is your sense of how demanding this moment is for the global shipping business?
Well, this is a developing story, and the region has not kind of been a safe area for shipping for a very, very long time. But now it's been escalating kind of beyond what we've seen for at any point in time, really. So it's a huge kind of risk concern. So far, the Houthis have been able to target vessels that have links to Israel, and actually, as they have quoted publicly. But it's such a kind of developing, and also, we lack oversight of actions being done in that area right now. News are coming in by the hour, so we're afraid that it's only a question of time until kind of we see a ship that's completely kind of unrelated to Israel or any parts of the conflict will be attacked.
So Lars, what are you and the team doing at Frontline to kind of mitigate these risks as you underline them? Have you stopped? Will you consider stopping sending your own ships through that area, through the Red Sea? Is that something you're weighing up, considering?
Absolutely, yes. And it's an analysis we do kind of by the hour. It's obviously the safety of the crew, also the environment. We carry crude oil or products through that region, and obviously it will be devastating if any of these ships were hit kind of during the passage. So this is something that we will consider all the time.
So when you say you are monitoring this and considering it all the time, does that mean you have made a decision at this point to divert ships away from that region, or you have yet to make that decision? You're still weighing that up?
We're still weighing that up, and I think a lot of people don't realize the fact that it's not always the owner that decides the routing of the ship, and that's a kind of a safety concern that the owner eventually will take. But the threshold is fairly high, and obviously we lean on analysis from the region, and since our company is in no way, shape, or form kind of related to the target fleets that are kind of highly exposed. We have had yet to take that position, to be honest.
Are there other mitigation or steps that you are taking to mitigate the risks?
We always travel through that region with armed guards on board and also in close connection with international kind of naval forces that are present in this region. So you know, this is a high tension region and it's been so for a long time. So this is kind of a close collaboration with particularly the various naval forces that are present in the region.
Okay, and Lars, you talk about that collaboration and the need to work with those naval forces in the region, allied or friendly naval forces. Is there more that you would like to see from various governments? Have you had closer conversations? Have you had conversations with heads of government or those who have influence over this region to get more support and more assets in that area?
You know, this is where kind of the shipping industry comes together, and the various kind of bodies, you know, in the regulatory side of shipping that actually do you know, engage in these things. So basically what's going on now is and it might sound incredible for people on the outside, but the region is actually not yet classified as war risk. And that's a decision that will be made by the ones insuring the vessels at some point, and that could happen today, it could happen tomorrow, or it could, you know, at some point maybe not be needed if the situation calms down. But you know, what normally happens, not normally because this is obviously not a normal situation, is that if the situation escalates further, you end up in a situation where the naval forces will arrange convoys. So basically you go in kind of in a secure manner and pass that strait. You have to remember that you mentioned it, that 12% of global trade passes through Suez. It's 8.9 million barrels of oil passing through this area every day of the week. And if you look at you know, how much oil is actually transported by water, this amounts to 21% of global kind of transported oil over oceans. So it's a significant part of the oil kind of the whole market.
I mean, it's huge, as you say, and you outline it succinctly there. What is the impact that you're seeing right now, Lars, on the tanker market, on those oil flows? And is there a risk that markets are underestimating the potential inflationary impact of all of this?
Potentially, yes. It's you know, there is actually a way around this, and you know, if you look at just the production coming out of the Red Sea itself, it's actually, you know, not to this extent. You're talking about between 1 and 1.5 million barrels that comes out kind of in the Red Sea, and that can be obviously routed north through the Suez Canal. In your map there, actually the area that we're talking about is further south, so it's basically at the mouth of the Red Sea going eastbound. So between Yemen and Djibouti. So that's where kind of most of these attacks have been happening. So basically what will happen is that, you know, the oil will flow, but it will just take a much longer route, basically go around the Cape or South Africa.
Okay. Lars Barstad, CEO of Frontline, really appreciate your insights with that kind of very much granular feel as to what is happening in terms of those flows of ships, carriers, and of course oil tankers in and around that region, as some, at least, some but not all, some divert away from the Red Sea. Frontline continuing to monitor developments before they make that decision. Lars, we appreciate your time. Coming up, we talk the impact of banking reforms with the Global Head of Research at Barclays. That is next. This is Bloomberg.
politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
The reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So a 250,000 cars in a market where there are million and million of cars every year.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Evolve a little bit, but I'll give you the way that I think about the metaphor here. We want a safe banking system, there's no question about it. We want safe cars driving on highways too, but we don't make a choice to have them drive at 10 miles an hour because that would reduce freedom of movement, it would devastate the economy. So we make trade-offs around making sure that we've got the right safety, but at the same time that we can really help to power the economy.
Okay, that was BNY Mellon CEO Robin Vince speaking to Bloomberg on his expectations of the Basel III capital proposals. And we will stick with banking reforms and the implications now and bring in Barclays' Jeff Melley, who has been writing comprehensively about this. A new report coming out on the 11th of December that we can bring to you now and break down for you with the analysis. Banking reforms, this is one quote, banking reforms have restricted capital mobility across jurisdictions, resulting in a decline in global contagion across funding markets. And as central bank balance sheets keep falling, US funding markets are more likely to be prone to risks than those in Europe. So the divergence there between the US and Europe, local versus global. I'm pleased to say that we are now joined by Jeff, the author, of course, of this report and the global research head or global head of research at Barclays. Jeff, thanks for your time. So talk to us about this divergence that is near the top of your report around the global risks that you say have reduced, but the local risks that you would argue have been exacerbated by some of these banking reforms.
That's right. Starting around 2016, regulators started to impose their new rules more at a legal entity, local level. That meant that parent organizations of big global banks had a much harder time moving capital from one subsidiary into another. So for example, before then, if there was a shock in the US market, they would move capital from Europe into the US. That would effectively dilute the shock. It would spread it across the globe, so you would see effects in Europe, but those effects would be pretty modest, and they would be modest in the US as well, because there would be money moving into the US to effectively defray that disruption. But now that's effectively impossible, or at least extremely difficult for banks to respond like that. And that's because, again, these parent organizations have a much harder time moving capital in between subsidiaries. So that global contagion no longer happens. You don't see the effects sort of ripple across markets globally, but that capital mobility was a great buffer. It helped dilute the shock. Absent that dilution, the shocks when they occur are much more severe. So you see shocks get worse, they're more frequent, they tend to spread to other parts of the local market. So one very concerning issue was that when there's a shock in certain parts of the US funding markets, you see U.S. Treasury markets become less liquid or get disrupted. And that obviously has been a source of concern for policymakers lately, the functioning of the Treasury market. And so what we find is that you're sort of making a trade-off. The trade-off is globally, we're more insulated from each other as markets, but locally, we're sort of left to our own devices. And when something goes wrong, those disruptions tend to be a lot worse.
And Jeff, it may seem counterintuitive to some out there that you're pointing out that the US, you're making the argument that the US is more vulnerable to some of these risks than Europe. Why is that?
Sure. Well, the major issue in Europe is that there's a collateral scarcity. And so you see some strange features of the market when bank balance sheets get constrained. There are certain entities that are desperate to put cash to work, and they don't have enough collateral to find. And so they tend to rely on banks, but sometimes banks aren't willing to provide them like a place for those assets. Now that's going to get better over time as the ECB balance sheet gets wound down. You'll start to see more collateral out there, and so these investors will become less sensitive to the availability of banks. But in the U.S., we have basically the opposite problem. The U.S. is running extremely large deficits, and we don't really see an end to those deficits anytime soon. That means the amount of treasuries that are out there in the market is growing. It's growing very rapidly. And as treasuries grow, the need to finance treasuries, the need to hedge interest rate risk, all that grows as well. And those are exactly the activities that banks are facilitating. And so what you're seeing is these large deficits effectively exacerbating the lack of bank balance sheets, and if anything, actually increasing the need for the mobility of capital across jurisdictions. But of course, banks can't do that now.
Listen, it would be remiss of me, and you talk about the term premium as well, and the fact that that is going to be baked in higher for a longer period of time. I want to get your views. I want to step back from this report that is well worth a read, and it's really comprehensive in how you talk about banking reform, the implications around liquidity and potential liquidity squeezes in these multiple different jurisdictions. But it would be remiss of me not to get your views on these equity markets as we look ahead to 2024. And I want to build up, or at least flag the quote coming from the team at Goldman Sachs. Costin and team revising their forecast up to 5,100 for the S&P 500 by the end of 2024. Where do you land on this view? How much more upside is there in these equity markets as we start to think about the cuts that may well come through from the Fed next year?
Well, we do see upside in equity markets from here, and we do have a slight preference for equity over fixed income. We actually expect slightly fewer cuts than the market does at this point. We're only expecting 3 cuts next year. Obviously, the market is pricing something like 6 cuts. And so I think that that will weigh somewhat on fixed income returns. But the momentum of the economy remains very strong, and I think that's really what's been reflected in the equity rally that we've seen. Obviously, it's been sparked by the Fed pivot. But the Fed pivot, I think, is being interpreted as a sign that interest rates are not going to disrupt the momentum of the economy. And so we do agree that there is continued upside in equities.
Okay, Jeff, thank you very much for your time. Jeff Melley of Barclays on the call there. That you're going to get less or fewer cuts than the markets are maybe pricing, but further upside for these equities on the strength of that US economy. And the views there, unpicking this report coming through from Barclays, trapped capital and the changing nature of financial shocks. Jeff, thank you very much indeed. Coming up, a look at some of the market moving events to watch throughout this week. Stay with us. This is Bloomberg.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Welcome back. Happy Monday. Let's check in on what else you need to know. It is on the agenda this week. Let's start in Japan. The BOJ rate decision is on Tuesday, followed by Governor Ueda's news conference. The survey from Bloomberg, the expectation from most surveyed there is that a move to undo those negative rates will not happen until April, but that decision is crucial. In Europe, we're going to get Eurozone CPI on Tuesday, UK CPI on Wednesday, expected to still come in with a 4 handle, then UK GDP on Friday. And in the US, GDP and jobless claims coming on Thursday. Then another read on inflation, plus personal income spending wraps up the week on Friday. Crucial for the Fed, of course. Checking in on these shipping companies right now, the major geopolitical story of the moment. Some are being diverted. Upside for these shipping companies. We continue to be across this story. Bloomberg Brief, surveillance.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology. And welcome to Balance of Power. This is Bloomberg.
The message we got from the Fed was very much and all clear. The markets responded in kind.
This market is behaving in a way that thinks that rate cuts are absolutely imminent and that we're going to have this Goldilocks scenario, and I don't currently see that.
A lot of the drivers for higher rates haven't left the market.
There is some skepticism around how much is the Fed ultimately going to cut.
Whether it comes to the Fed's forecast being realized or the market expectations being realized, I think the truth in the end will lie somewhere in between.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
What a difference a month makes. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Your Monday morning price action looks like this. Equities just about positive by 0.2% on the S&P. Here's the big call to kick off a trading week. David Costin at Goldman Sachs with a new price target on the S&P for next year. That price target is 5,100. The old one is about a month old. It was 4,700. Here's the quote from the team over at Goldman. Equities were already pricing positive economic activity, but Lisa now reflect an even more robust outlook.
And the reason why it is because, drum roll, Jay Powell came out and basically said that we're talking about rate cuts, but maybe they're not talking about rate cuts if you listen to John Williams over at the New York Fed. Maybe that's premature to talk about it if you listen to Austin Goolsbee. The point is, everyone heard what Jay Powell had to say, and they're going to run with it because this is a dovish Fed that has a bias to cut.
That pushback got absolutely steamrolled again by Williams and maybe by Goolsbee again this morning. Here's a quote from Morgan Stanley's Mike Wilson. Yes, really. He says this is a bullish outcome for stocks. Even the bearish Mike Wilson of Morgan Stanley is joining in. How credible is that pushback on Friday and again over the weekend?
Well, I think the market has voted, and the vote had said that it wasn't very credible at all because, frankly, it was just the Fed chair basically saying the quiet part out loud when everybody else was saying, please, don't let financial conditions ease too much. And he's saying, let her rip. I mean, essentially, he had a chance to push back. He didn't. He had a chance to say that financial conditions concerned him. He didn't. He had a chance to say a whole host of things that he did not do, and that's what spoke volumes.
Just to clarify, are we talking about rate cuts or not?
If you parse through the words, some members brought up rate cuts, but they're not engaged in a deep conversation where they're saying, are we going to cut in March and exactly how much? To me, it seems like they are absolutely thinking about it. It's just a question of whether it's the main tenor of discussion. These are nuances. People heard what they needed to hear.
Prepare yourself. We have more Fed speak through the week. I'm sure you're really excited. We've had ECB pushback as well. The pushback is only as credible as the data behind it. And the data behind the pushback in the ECB, it ain't there. The IFO index, German business confidence was pretty weak. European economy is pretty weak. The PMI's on Friday, pretty dreadful.
Which is the reason why the market rejected that too, and why the pushback over at the ECB and frankly even the Bank of England didn't get as much attention as Jay Powell and what he had to say. And this is what's notable to me. The strength is in the economic outlook for the United States. And yet the most dovish tone is from the Federal Reserve of the United States. The outlook does not look good for the ECB in the Euro region, and yet they're trying to maintain a hawkish tone, and it's not necessarily gaining the credibility.
So what do you do? Well, I can tell you what people have been doing. They've been buying stocks. Equities on a 7-week winning streak on the S&P 500. Equities this morning, the scores look like this, up by 0.2% on the S&P. The euro a little stronger, 109.10 on the euro against the dollar after having a little look at 110 going into the weekend. And in the bond market, yields down by another basis points, just a little bit lower to 389.78. Lisa, what a turnaround in the bond market.
It's just shocking to think that we've come down more than a percentage point from the October high. What we're looking at this week, Tuesday, we've got a Bank of Japan rate decision. I think it's going to be interesting because people were thinking this is the time for them to, drumroll, exit negative interest rates. They still have negative interest rates. And then people said, well, the economic data wasn't good enough for them to do that. We've already seen people reprice a bit stronger yen versus the dollar, but really still that feeling that they're not going to move away that quickly is embedded. Wednesday, another auction. They don't matter until they do. $13 billion of 20-year notes coming at a time when you've seen this dramatic repricing, more than a percentage point decline in that 20-year note. What happens if there's weak demand? What happens if people start worrying about the deficit? Or is that basically off the table? Because suddenly we're talking about the Fed.
Into the studio on Wednesday. ETK is making an appearance.
For the auctions?
Just in for one single day this week. I have no idea if it's the auctions or not, but it will be Wednesday.
So that we'll make sure to get his take on the auctions. And Friday, this actually is going to be interesting. Again, it's only as credible as the data behind it. I think that that's a really good comment of yours. U.S. November personal income and spending comes out, as well as core PCE deflator. Does it keep coming down? If it doesn't, does that challenge this idea that the Fed is as dovish as Jay Powell?
Feels like week over. Let's get to it. Year over. Steve Chevron joined us around the table, head of multi-asset at Federated Hermes. Steve, good morning to you. Good morning. What a difference a month makes. Are you more bullish now than you were a month ago?
2023 was a year where, despite having concerns economically, we held our nose and we bought. We thought the consensus early in the year was too bearish for an early year recession and then a second half recovery, and we bought equities. And then we were too underweight growth, and you got to sell off in the summer, and we bought equities. And I don't think we were necessarily more prescient than anyone else, but it worked. And I think what you're seeing with these price targets moving up is earnings have inflected positively, right? We saw that. We went to, year-over-year earnings growth. You could forecast earnings growth in 24. You could feel decently good about that, but you couldn't get to the idea that you'd get any multiple expansion. But if the Fed really is, and we'll call it thinking about cuts, to throw back an old term, then you can start to think about, well, maybe you do get a little bit of multiple expansion. And I think that's why you're seeing so many strategists up their forecast for next year, because there's a multiple expansion component they didn't have before.
We've got broader participation. Small caps really starting to rip. Financials, the bank's looking good as well. Do you think that improving breadth is a head fake or the real deal? How do you know?
I think that's something you watch. I think as you go through next year, right, really the argument here still is, if it's still out there, is this a final gasp of the last rally before, Armageddon, which is not our view? Or is this the beginning of something that's a little bit more sustainable? It's going to be more sustainable if it's broadening out. If smalls are performing, if financials are performing, if transports are performing, if discretionary is leading, those are signs that you've got a sustainable move, which is why I think the last month or so has been encouraging, because it's the first time you've seen that this year.
I just want to note that there have been 6 other times that the market has embraced this idea of some dovishness and then gotten some cold water dashed on it because of economic data that came out stronger than expected. How offsides is this market going to be if we do get some sort of reacceleration in inflation?
Well, I think it depends on how much, right? So if we're talking about an extended pause, pauses historically are the best environments for equities, much better than when the Fed's cutting. So if you have upside surprises to inflation that would react, if this Fed, after that press conference, had to go back and hike, then yeah, that would be really bad. But if it's strong enough data just to keep them on hold, frankly, that may be better than cuts, because they usually cut for a reason. And so cuts would suggest that you see continued economic softening. If it's stable and they're on pause, that could be just fine for equity markets. I think the bond market is where you might have some issues, because that's kind of gotten ahead of itself.
That's where I wanted to go. Do you expect the rally to continue in tandem with bonds and stocks, or will the divergence start to become more material in the new year?
I think that the scales have tipped in the direction of equities here, right? Bonds have had a big move. They had an immediate move right off of that press conference. It may be overdone. I don't think we're necessarily going to get 6 cuts next year unless there's really some meaningful deterioration in the economy. But I think equities have a ways to go. And I think you could see them test and challenge and surpass the old highs. That's always been our call. Even if you do end up having a recession, markets always hit a new all-time high before they do that. So I think there's a much better risk return in equities right now than there is bonds, and that's different from a month ago.
I've seen lots of economists over the last few days trying to explain the difference between cutting interest rates and easing policy. Yep. Do you think for markets that's a distinction without a difference?
Look, again, I think it's about context, right? If you're talking about a couple of cuts that are trying to keep the real rate basically where it is, that's the behavior that you see in the very, very few soft landings historically. If it's aggressive cuts because you've got an unemployment rate that's rising and you've got defensives that are leading, then that's a much less benign scenario. And I think that everyone needs, humility was something that if you didn't come into 23 with it, you probably should be leaving with some. I think you want to bring that into 24 as you think through things and understand what's going on in the economy, what's going on in markets in the context of those cuts. Otherwise, you risk being humbled yet again.
Would you like some more pushback from the Federal Reserve? This courtesy of Colby Smith over at the Financial Times, an interview with Loretta Mester, the president of the Cleveland Fed, with this to say: the next phase is not when to reduce rates, even though that's where the markets are at. It's about how long do we need monetary policy to remain restrictive in order to be assured that inflation is on that sustainable and timely path back towards 2%. Here's the big one. The markets are a little bit ahead. They jumped to the end part, which is we're going to normalise policy, and I don't see that. Now, hawkish member of the FOMC, we know that in Loretta Mester. But it's hard to say the market is wrong after what we heard in the news conference from Chairman Powell. I'm a little bit lost. What was Chairman Powell doing?
Welcome
in that
to the
news
club,
conference?
John.
I'm not alone, am I?
Look, I mean, it makes sense to struggle here. It makes sense to ask questions about how long do we stay at this rate? When do we think we've gone too far and we want to remove some of the tightening? It's just a communication strategy, which we were talking about before the air. It's difficult when you've got the chair with a very, very dovish message and then members of the committee are walking it back. Again, I think I miss the days when we guessed the size of the briefcase from Alan Greenspan. It was simpler, rather than reading the tea leaves of the different comments.
They can't put the toothpaste back in a tube now, can they?
Well, that's the issue. The market was ahead of the Fed. We were expecting, and I think most of the market was expecting Chair Powell to push back against that a little bit, not wanting financial conditions to loosen too much, and he didn't. Now, I can't imagine that that was a mistake. Now, I don't know if he's negotiating with the rest of the committee in public or if he's trying to get the market prepared for a series of more dovish messages as we get into 24. I think what the market has taken, though, is that in any event, hikes are off the table at this point.
Do you think that he's bad at his job, or do you think that he just doesn't agree with most of the other members?
Lisa, I have a hard enough time doing my job. I'm going to criticize the chair of the Federal Reserve. No, I mean, he's got an impossibly difficult job. And I think, my comment was I think he's always felt that there was some element of this inflation that was transitory. And you have seen it come down on the supply side, which, in fairness to him, is somewhat indicative of that. In that event, with rate hikes not really having been felt through the economy, there is a risk of over-tightening, and I think he wants to stick this landing on the soft landing. And so I think he's trying to push the public and maybe the committee into that direction. And you know what? He may not be wrong. He may not be wrong. It's just when you have the pushback coming from other governors, it's hard to figure out how to interpret that message.
That's what's difficult, I think, for that news conference. In the news conference, the chairman should be trying to represent the consensus on the committee, not his own opinion. Shouldn't have been the opposite, shouldn't it? That's where I'm leaving this particular conversation scratching my head. I don't get it.
To me, I think he's not that worried about financial conditions easing. And right now, I think that it's very hard, to your point, to really undo this message. I'm looking at 2-year yields in response to Loretta Mester, unchanged.
Mohamed Al-Arian this morning in the Financial Times, well worth a read. The line of the conclusion: the inflation round trip is neither simple nor complete. Much more on that a little bit later. Love this tweet out on Twitter this morning. Known as X, I know. Here's the post. New drinking game. Every time someone on Bloomberg says pushback, you're drunk by 6:12 in the morning.
Does this even count as pushback, though? That's my question. If nobody's taking it as pushback and more just like damage control, they've got to do their due diligence.
It's not seen as credible, I'm with you.
Yeah, and that's sort of what we're seeing this morning.
That is without a doubt what we're seeing this morning. Steve Chevron, thank you, sir.
Thanks for having me.
See you.
Happy New Year.
Merry Christmas to you. Thank you very much. Looking at futures, equities positive by 0.2% on a 7-week winning streak on the S&P 500. This is the longest weekly winning streak going back to the end of 2017, November 2017, I believe. We'll speak to another equity market bull, Jay Pulowski of TPW Advisory, who's feeling very good about himself. Looking at recent notes from Jay. Jay feels vindicated.
Yeah, I'm sure he does.
By what we heard from last week. Got to talk about politics as well. We'll do that with Ed Mills of Raymond James. The latest polls, not great reading for the President of the United States. The hypothetical head-to-head over at Fox News in their recent poll, loss, 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 almost across the board.
Well, it's been consistent, and it doesn't matter who's doing the actual poll. And what strikes me is the underperformance among younger individuals, particularly within his own party. And that divergence of generations is something that's really marked with respect to a whole host of issues.
We'll get to the details of that poll in around about 5 minutes. We'll catch up with Anne-Marie in the next hour as well. Plenty still to come this morning. Equity futures on the S&P 500 positive by 0.2%. Yields just a little bit lower by a single basis point, 389.60. And in the FX market, the euro showing some strength despite some weak data, 109.10 on the euro against the dollar. From New York City this morning, good morning.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise?
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. Only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley.
I agree with a lot of Trump's policies. I think he was the right president at the right time. But looking at the situation now, our country's in disarray, the world is on fire, and chaos follows him. And we can't have a country in chaos for 4 more years or we won't survive it.
That was Republican presidential candidate Nikki Haley speaking to ABC over the weekend as a new CBS poll show that Haley is closing in on Trump in New Hampshire. That's the latest for Nikki Haley. Things are looking better. For the President of the United States, things are looking worse. Lisa, this from Fox. In hypothetical general election matchups against President Biden, Haley is ahead by 6 points. Trump is up by 4. DeSantis and Biden tie. And as recently as August, according to their polling, Biden was narrowly ahead of all 3 of them.
To me, what stuck out to me was a Wall Street Journal poll that kind of was another side of the same coin, saying that Democrats and independents, 45% of them who were polled said Biden's policies hurt them personally or had no impact on them. So he's losing on the economy, even though by certain metrics, economists are talking about a really golden economy entering a new phase of expansion.
Our poll was pretty brutal last week for the President of the United States. We've done this a few times now with Morning Consult. When respondents were asked which leader they trust more to handle the economy, it's President Trump, it's President Trump, it's President Trump, leading 51 to 33. That's a massive spread. 16% said neither.
In this Journal poll, 49% said Trump's policies personally helped them. Just 37% said they hurt them. So again, it's the exact same kind of message. How much is this entirely tax cuts? How much is this the economic expansion? It doesn't matter. How much is this the messaging? Either way, Biden is not getting his message across, and inflation is really taking a bite out of some of the sentiment from voters.
Ed Mills joins us now to have this conversation, Washington policy analyst over at Raymond James. Ed, let's start there. Is it personal? Is it the economy? Is it something people aren't seeing? Ed, what is it?
Well, I think it's a combination of things, Jonathan. 2 things we always look here at Raymond James: approval rating, right track, wrong track. President Biden is underwater on both, especially on the right track, wrong track. And when people don't think you are doing a good job and do not think the country's on the right direction, those are flashing warning signs. Now, if it is a head-to-head matchup between Biden and Trump, one of the questions become is how much of it is a referendum on Biden or how much of it is a referendum on Trump? Because Trump also has very high negative ratings. And one of the things I think about as I compare these candidates is that Donald Trump is always one of those candidates that has a high floor, low ceiling because of the intensity of his support among his base. That floor for Biden is lower because there's less intensity, but in a head-to-head matchup, I still think this is a very close election, which will be decided by a few, swing states come next November.
So, Ed, are you saying that maybe the White House should just trust the calendar, that things will close over the next 12 months?
I think they should be nervous. I don't think you can trust the calendar. I just think that there's a lot that needs to happen between now and next November. And I do think when I go around talking to kind of clients, I was in LA with Raymond James last week, and there's this nagging sense that there's something that's going to happen in this race that's going to upend things that we just don't know. Those unknown unknowns. People think that we probably are going to see this rematch, but people are watching Haley. People are watching for a third-party candidate. People are watching for that surprise. And so this far out in these head-to-head matchups does show flashing warning signs for Joe Biden, but I don't think anyone has great certainty right now as to who will be in the White House come Inauguration Day in 2025.
We've spent years talking about the schisms in the Republican Party, most recently with the House Speaker and the debacle around that. There's a question about how big the schism is between the Democratic Party in terms of the progressive wing and the rest of the Democratic Party, and whether any Democratic candidate can really pair those at a moment that's incredibly polarized.
Yeah, Lisa, and I think that's exactly part of the reason why you see Joe Biden polling relatively low, is that schism for those folks that are not in favor of some of Biden's policies. They're not saying that they're going to vote for him. So the job of the Biden campaign is going to be making sure they have enough of a contrast against whomever establishes themselves as the Republican candidate, assuming it is Biden on the Democratic side, and get them to the polls. They can't have them sit out. They need to energize them. That's where his kind of floor is lower than Donald Trump, because that intensity and that schism within the Democratic Party does not have anyone being rallied around at this time.
We have another year of this. We're all very excited. There's a question of whether there are specific aspects of the race that the market participants who you talk to are particularly interested in. Is it the deficit? Is it foreign policy? Is it something on the domestic front with border control? What is it from a market perspective that people are most trained on?
Yeah, Lisa, it's all of the above. First and foremost, we're going to have a really busy January. The Senate's still negotiating a potential border deal, which includes money for Ukraine, Israel, Taiwan. That's probably getting kicked into January. But in January, we also have the Iowa caucus, the primaries in New Hampshire. Taiwan has an election. We have a potential government shutdown. There's 1% across the board cuts that get triggered because we didn't finish up our appropriations process here in Washington, D.C. I am getting more questions about the debt and the deficit, how that plays into not only the election, but we look after the election, and there is the expiration of the Trump-era tax cuts coming in the end of 2025. And so D.C. is more of a conversation for this market than historically. And I would just end that, Lisa, with the fact that when we look at the markets in presidential election years, January to March frequently is a weak period for the market because that has some of the most greatest uncertainty as the parties are choosing their candidate. And so we have this kind of run-up that we've had here. We've had this optimism because of the Fed. Will we see that continue into January and be an outlier? Or are we going to return to what we saw, especially, say, back in 2020, when it looked like Bernie Sanders might be the Democratic nominee and the volatility that caused in the market? Will we see a repeat of that? Or is there something that's going to emerge? Is Haley going to emerge, and that is going to kind of see a stronger market than anticipated at this point?
And I'm with you. Things get busy quickly. Let's start with January. Just give us those key dates. January, February, the deadlines where they have to come to some kind of agreement on spending.
Yeah, so January 19th is the first deadline. February 2nd is the second deadline. What I'm watching with this border and kind of defense supplemental is, do they require a bill to get funded also for the entire defense budget? Because if they were to do that, then Republicans, they have a stronger hand in pushing budget cuts elsewhere. And I don't think the market is prepared for those budget cuts. If we have a government shutdown, one thing that we would highlight is that in the past, when the government is shut down, the market on average is up more than 3%. Beyond that, it is the Iowa caucus on the 13th. The 25th is the New Hampshire primary. So just jam-packed dates. And Congress returns on January 8th.
And I mentioned the polling that came out of Fox over the weekend. Number one issue, both parties, the economy, the economy. The southern border is a close number two for Republican voters, doesn't feature that highly for Democrats. Is that where the fight's going to be early on next year?
Yeah, so Jonathan, that is exactly why Republicans are insisting on getting something done on the border in exchange for that Ukraine, Israel, Taiwan aid. You look at House Republicans, they're on the floor of the House of Representatives saying they've gotten nothing done. They want to have the key issue for their constituents solved, or at least have progress on that. So when they run on their own races in 2024, they can point to something. This is the one area where we know that there's still broad bipartisan support to get that aid package on the military side. And so they think, rightfully, this is their opportunity to talk about other national security issues, the southern border, and will be pushing. Now, what they're asking for is more than what Democrats want to give. But unfortunately for Democrats, they're going to have to give it to get the other side of this funding done.
Got it. Some unsettled business spilling over into 2024. Ed, thank you, sir. Ed Mills there of Raymond James. Some breaking news on BP. The latest reading as follows. You will recall that there have been a series of attacks by Houthi militants off the coast of Yemen. Big shipping companies working out whether to send their crews through the Red Sea. We saw Maersk and another big shipping company pause that just last week. BP to pause all oil tanker transits through the Red Sea. That headline crossing just moments ago. More on that in just a moment. From New York, this is Bloomberg.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Live from New York City this morning. Good morning to you all. Equity futures on the S&P 500 positive by 0.2% on the S&P 500. 7 weeks of gains on the S&P. We have not had a week of losses since October. Exactly the same winning streak on the Nasdaq 100. Futures up there by just 0.06%. But the massive outperformance has come from elsewhere. The Russell more recently, the small caps doing well. The banks are up 26%. Over the same period. So I'm going from the end of October. The banks are up 26% on the S&P 500, helped out by this move in the bond market. 2-year, 10-year, 30-year, well off the highs of October. North of 5% in October, back down to 390 this morning, down almost a single basis point. Lisa, on the 2-year, we were talking about 525, 526 in October. Now we're talking about 442, with yields lower this morning by 2 basis points.
Do you remember when we worried about the deficit? Remember we worried about who is going to buy all this debt?
Yeah, like 2 months ago.
Yeah, exactly. Like all these stories that people bought into, and then we had an auction and it was catastrophic and people were so concerned, and it edified this feeling that this is a new era, and suddenly it's back to the future and we're back to where we were before.
Those issues haven't gone away. They're still with us, aren't they?
This, to me, is the issue. That if anything, it makes it more likely that the Bank of Japan is going to move away eventually from negative rate policies and normalize what's going on there. You're hearing a hawkish message from the Bank of England and from the ECB. So at a certain point, is there some room between where we were a month ago and where we are right now?
Drinking buzzword of the day, pushback. We've had pushback from Williams of the New York Fed on Friday, from Goolsbee of Chicago over the weekend, from Mester of Cleveland this morning, and nobody seems to be listening. That's the interesting part of all of this. If you get any encouragement, you latch onto it. Any pushback, you ignore it. That's been the story now for a number of weeks, hasn't it?
Fed Chair Jay Powell answered a question directly. He said, yes, we are talking about, just roughly the timing of rate cuts. We're beginning to talk about it. New York Fed president said they aren't really talking about rate cuts. So what constitutes really talking about it versus talking about it? Essentially, they brought it up, but they're not necessarily examining, doing a forensic analysis of exactly when they're going to cut rates. It doesn't count as pushback when you got the chair coming out and talking about it.
The market is not listening. Let's turn to foreign exchange. The ECB tried to push back, but the data is just absolutely terrible, so none of it has any credibility. The euro is just about positive by 0.1% at 109.12. We did not hear Chairman Powell in that news conference, Lisa, on Thursday morning.
What we heard from ECB President Christine Lagarde was really just sort of this feeling that they need to stick with it, this feeling that they're not thinking about rate cuts, this feeling that they are not the Federal Reserve. But the reality is, no one was listening to her either, because Fed Chair Jay Powell set the tone and the data just isn't there to support an economy that can withstand rates at this level for a prolonged period of time.
Let's start there. Under surveillance this morning, German business expectations worsening for the first time since August, dampening hopes of a recovery in the nation's biggest economy. A gauge of expectations put out by the IFO Institute fell from the previous month. Analysts had been expecting a slight uptick. Lacey put together that with the PMIs on Friday. Not a great picture of what's happening in the European economy. economy.
It's the biggest economy in the region, so if it's having trouble, you have an issue here. So at this point, can you get the same kind of commitment to holding rates high, especially when inflation's coming in faster in some measures in Europe? Or even relative to the U.S. I mean, the services sector isn't seeing the same kind of inflation that's, inflecting upward in certain areas in the same way. So there's a real question here about how sticky this is and how much they're going to be able to deal with more disinflation heading into next year.
Speaking of hits to business confidence, I promised you an update on this story. Here's the latest. BP pausing all oil tanker transits through the Red Sea. The announcement following an escalation of attacks on merchant shipping by Houthi militants. Maersk making a similar announcement on Friday. About 12% of global trade depends on the Suez Canal. Clearly some big questions for the U.S. military, the administration, and for these companies.
This, to me, is the big sleeper story of the next couple of weeks. To me, this is actually the most important thing to watch because, A, it has to do with a significant portion of global trade. B, you're dealing with this question, a real breaking apart of certain Middle Eastern allies and the U.S. in terms of how to deal with this because the allegiance of different people are behind different factions about how to really counter this. And then you have this issue of, okay, well, what does this mean for supply chains? Do we then get an inflationary pop if you can't get some of these goods shipped, or at least not the same kind of deflation that we saw in the past couple of months?
Do you remember that massive ship and everyone freaking out a couple of years ago?
Yes.
Do you remember that?
Yes. Well, this is that on steroids.
That on steroids. Okay.
I'm just saying.
Okay. There's the update there. Here's the update on the south side. Goldman's David Kostin already lifting his 2024 S&P 500 price target, seeing the index at 5,100 by the end of next year. Now, just a month ago, the price target was 4,700. Just a month ago. That's a big lift. Kostin writing this. Equities were already pricing positive economic activity, but now reflect an even more robust outlook and clearly one that they are constructive about.
What happened with the robust outlook? There was one thing that happened, and that was Jay Powell.
Without a doubt, that's the only thing that's changed in the last month, isn't it?
He created the robust outlook, that basically he wasn't going to push back and try to curtail this.
Jan Hatzius already had what they're calling a robust outlook over at Goldman Sachs.
Exactly.
They said the hard part was over, the easy part is still to come. And then Chairman Powell just gets some gasoline and pours it on a fire, doesn't he?
Takes a lighter and just goes nuts.
Chucks a match on a bonfire. Let's go.
You said something earlier, and I think we have to really stick to this. Does the data confirm it? And a lot of people are saying, like Neil Dutta, that there's nothing in the data to be inflationary. Everything's going to be disinflationary in the next couple of months. So if that's the case, does this just keep running regardless of any kind of pushback? Because the data is going to confirm the disinflation, and we know the reaction function, at least, of Fed Chair Powell.
That if is not a big if in a mind of Neil Dutta. I'm really pleased to say that revisiting us around a table is Priya Misra, portfolio manager at JP Morgan Asset Management. Morning, Priya. We were talking last week on Wednesday going into that news conference with Chairman Powell pushback. I was with you. Surely we were going to get pushback from the chairman. We didn't get any. Your point, I think, is an important one. Are we dusting off the 2019 playbook? And for those that might have forgotten, what is the 2019 playbook?
So in 2019, what the Fed did was try to, cut rates. They cut rates 75 basis points, really trying to extend the cycle. I think this is the Powell Fed. This is the Fed that says once they get the green light from inflation, what did surprise me was how quickly they're convinced that inflation's actually going to head all the way back down to 2%. They're trying to get that soft landing. They're really, really trying to get that. And if that means that they can normalize policy, that they can get real rates, I think, closer to 1%, 1.25%, they think they can actually extend the cycle, that we don't get that recession. I think it's a little, little bit of a risky move here, because what if inflation does stall? But if you're at 2.5, that's not that far from 2. Now, whether it'll work or not, I think that's the trade for 6 months out. Right now, we're in immaculate disinflation. We're seeing growth slow down, but not to recession levels. And they're hoping that by these preemptive rate cuts, that they can actually, get that soft landing.
Language matters. You didn't say easing. You said normalize. What's the difference?
There's a big difference. Not every rate cut is essentially created equal. I think the Fed right now, the market's hearing the Fed is cutting to the Fed is easing. I think what they're trying to do is get rates to some sort of neutral level. We don't know what neutral is. Now, we'll be debating R-star for the next year. What's that level at which point policy is essentially accommodative? We're very far from accommodative. In fact, Chair Powell said that last week. He said we're well within restrictive territory. Normalizing, in my mind, is getting rates to, Fed funds 2.75, 3%, something in that range. easing would be well, below that. We're talking 1%, 2%. The market right now is pricing in normalizing. So when I hear that too much is getting priced in, no, we're pricing in inflation getting back down close to 2%, 2.5%, and growth in that 1% range. 2.75 or 3% Fed funds is normalizing. I actually think we still don't price in this chance that the Fed may have to cut well through that, because they're trying to extend the cycle. But what if the damage has already been done? What if the lags kick in? I think there's a chance that the Fed may have to cut, well south of that 3% level, which the market's not pricing in, which is why I think there's more room for rates to decline.
Why do you think there are so many Fed officials lining up to push back on what we heard from Fed Chair Jay Powell, if it is consistent with what they hope to do?
I think they're really trying to prevent getting bullied by the market to cut all the way down to 0 or 1%. Whether that'll work or not, I think the market's saying... The
market's not even bullying them to that degree. They're only billing them 150 basis points.
Exactly. But what if the growth data does start to slow down? Then I think the market might say, well, you're going all the way down to 0. And I think the Fed is saying, well, there's a very different bar. There's a different bar to normalizing. We've reached that bar. And then there's a different bar to actually take rates into accommodative territory. It's a very nuanced message, but it's very hard for the market to actually make that, for the Fed to make that point, and secondly, for the market to hear it. So I think the trade for today is the Fed's going to ease. They're trying to get that soft landing. Until we see data that it's not working, it's risk on.
Well, but here's my issue. There was a time when we thought that the easing in financial conditions mattered, that it actually would have some sort of stimulative effect on the economy and potentially on inflation. Fed Chair Jay Powell had an opportunity. He had a softball to respond to that, to basically lean into that message. He did not. Do we take a message from that they don't care about the easing in financial conditions, or do we take a lesson from all of the other Fed officials that are trying to say it still does matter?
So I think financial conditions are always context dependent, meaning, financial conditions have eased, but so has inflation. Inflation's come back down. Look at 3-month moving averages. We're running, south of 2.5%. And the growth data is weakening. I mean, even if you look at payrolls, which is the strongest part of the economy, if I strip out a few sectors, it's actually looking pretty weak. The consumer is levering up, and we are seeing essentially a pickup in default. So I think if the household sector is starting to weaken, the Fed looks at the easing in financial conditions and says, actually, it's appropriate. So I don't think they push back. Now, if we see a re-acceleration in growth, absolutely, the Fed's going to push back. If we see inflation stalling out, I think they'll say not so fast. But for now, if growth is slowing down, I think financial conditions matter a lot less.
Let's go through the levels. 2-year right now, 442. 10-year at the moment, 390. 30-year, just above 4%. How much space is there for yields to fall from here, given everything you've just told us?
I mean, it is going to depend on the data. My view is things are slowing. And even though financial conditions are easing, the Fed's talking about rate cuts, it's hard for that to have an impact on the economy that quickly. So I think the 0 to 5 or 7-year part of the curve can absolutely decline a lot more. We should price in at any point a 10-15% chance of a recession. You start to put that in, and then you're looking at the 10-year or the 5-year closer to 3%. So I think there is room for it to decline. May not be a straight line. We've come a pretty long way very quickly. 2 months ago, we were at 5% on 10s. We're talking about, the supply narrative. So it's moved a long way. I think it can consolidate, but I don't think we're getting much of a backup. So I would use any backup as an opportunity to buy. I think we can have a pretty flat curve around 3% for the next few months.
Well, let's talk about the shape of the curve. I'm pleased you went there. You've alluded to this. Just why is this curve still at negative 51, 2-year versus 10-year? Why aren't we getting that classic end-of-cycle bull steepener come through? What's happening?
I think that's, to your question earlier around normalization versus easing, I think the market, that's the part of the market that understands that this Fed is not talking about easing all the way down to 0. The curve will really steepen, I think, when we see signs that we're in front of a hard landing is in front of us. If we're still in a soft landing, I think we have a very flat curve. There should be some term premium there. But here's my pushback to term premium. There's $6 trillion sitting in money market funds. Cash has felt good, right? I'm earning more. If the Fed hikes more, well, I'll earn more. Well, now actually think about reinvestment risk. As the Fed starts to cut rates, those rates are not going to stay that high. Money is going to move out, and it's not obvious to me that all moves to stocks. When real rates are close to 2%, bonds start to look very attractive as well.
You said things were slowing. Can we finish there? What is guiding you? Where are you looking across your dashboard right now, looking at various economic indicators? What's guiding your assessment of where this economy is going? Because I've looked at a range, forward-looking indicators for a while now have been signaling slowdown, and then Q3 happened. So what are you looking at?
Right. So, I think Q3, part of why Q3 happened or that strength in the data was real incomes surging. Inflation declined, but wages were still high. Well, that's starting to decline because if you look at wage growth, so what I'm looking at is I'm basically looking at the household sector. So I'm looking at small business hiring. That sentiment seems to be slowing, and I'm looking at the consumer. So at the margin, you're seeing cracks. We still don't know if the cracks will be systemic enough, and can the Fed, this preemptive easing, actually prevent the cracks from deepening? But there are cracks in terms of the consumer, leverage, in terms of consumer defaults, delinquencies. So there's signs of trouble. I think it's still too early to say is this hard landing, but we should put in some probability of a hard landing there.
Priya, it's good to see you. Always is. Priya Misra there of JP Morgan Asset Management. Lisa, just on the difference between easing and normalization, which is something we've been talking about in the last hour.
Which is the reason why the Fed does have a kind of a nuanced message to send out there. How do they convince them? This is just normalizing, not actually easing.
And is that a distinction without a difference of financial markets that are absolutely ripping? More coverage still to come. The outlook from Wells Fargo. Up next from New York, this is Bloomberg.
I used to have a data point I used to share that 75% of the people had never heard a phone ringing. Just think about it. I didn't say had never used a phone. They'd never heard it ringing. Today, 75% of the African people have a mobile phone. They use one, okay? And we will do the same with the internet in the next 5 years. We will do it as an industry, as entrepreneurs. All we need is the space, and we need investment support, because we are the best investment case for this in the world.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Even if you manage to skirt around the recession, which is certainly possible, and the data doesn't show that we're in imminent danger, but even if you do, there is likely going to be a growth scare time just because there's so much optimism in the markets right now. Based on what we've seen, the Fed is likely going to try and be as quiet as it can for the next several months.
I'm laughing out loud. Julian Emmanuel of Evercore, they're doing anything but staying quiet going into the Christmas period. We're hearing from more of them. Lisa Williams on Friday, Goolsbee over the weekend, Mester in the Financial Times this morning.
And they're all trying to basically sing from the opposite hymn book of Jay Powell. Again, this goes to the question, what are they worried about? Are they worried about financial conditions getting carried away? Are they worried about being bullied by the market, as Priya Misra was saying? Or are they just trying to be the last voice before the end of the year to try to, I don't know, be responsible amid a party?
I'll try and be responsible. Prudent to maybe reintroduce some two-way risk after what we heard from Chairman Powell and we saw in markets after that. Precisely. Just not landing. It's not landing at all.
Well, I'm sorry. When the chair speaks, the chair speaks. And if he's on a different page than the rest of the committee, well, then we have another problem.
Well, Chairman Powell Wednesday was on a different page to Chairman Powell 12 days before, so keep up. To Julian Emmanuel's point,
Thanks.
the bar has reset, not you. Me too. The bar has reset big time going into 2024. Wells Fargo calling for the economy to contract next year. The economist Shannon Seary-Grind writing this: there are unmistakable signs the momentum in this economy is downshifting and cracks are beginning to appear in the household sector. Shannon, I'm pleased to say, joined us now. Shannon, we're going to dive deep into the Fed speak in just a moment, but your outlook is calling for that contraction. Where are you seeing weakness currently, and why do you think that continues into next year?
Yeah, so we're still seeing some of those early cracks in the economy. So we still think recession risks are elevated into next year. Obviously, we think the Fed is done at this point, and it really comes down to when they start to ease policy, where I think you could potentially avoid that contraction and achieve this soft landing. But what we've been really trying to stress for clients is a soft landing or a mild contraction is probably not going to feel all that different, right? We're looking for slow growth in 2024, and in terms of where those cracks are really starting to materialize, we are starting to see some in the household sector. So the household sector is in decent financial shape at a very high level, but those initial vulnerabilities are starting to rise with delinquencies ticking higher, interest expenses starting to pick up as well. So I think you're starting to see a household sector that's beginning to think about changing their behavior.
So Shannon, I thought that Chairman Powell had started to change his behavior as well. In the news conference last week, I heard a chairman that was entertaining a conversation about rate cuts. Then Williams spoke on Friday to CNBC. Goolsbee spoke over the weekend. Mester this morning to the Financial Times. How credible are those clarifications from those Fed speakers?
I think we should be paying very close attention to what the Fed speakers are saying at the moment. So I think Powell surprised most of us with how dovish he was at the recent press conference, and I think we're seeing some of that being walked back by the latest speakers. I think the market has just gotten really excited about easing, and I think the Fed speakers are trying to walk back some of that so that they don't see an overly accommodative stance happen in terms of financial conditions that puts them in a more precarious situation as we go into next year with inflation still meaningfully above target. They still have work to do. They need to remain in this restrictive stance for some time. So I think they're trying to walk back some of that market excitement to the best they can after Powell's more dovish comments last week.
Let's pair these ideas together. I love how you say they're beginning to think about changing their behavior, talking about households, and sort of beginning to think about rate cuts over at the Federal Reserve. And you put these two things together and you wonder if some of the accommodation that we've seen in markets will change people's thought process in households who are thinking about changing their behaviors to be a little bit less, I don't know, ebullient when it comes to shopping. I mean, is that what you're seeing, that you think that financial conditions matter a whole lot at this junction?
I do think they matter for households more than we would think so, just based on how they follow markets. So what I mean by that is I think that consumers have been remarkably resilient over the past few years. I think the wealth effect has something to do with that, just given how sturdy their financial situation has been, and the rise in equities, the fall in yields. I think that could add to some further strength in consumers, more than we're expecting. So our forecast is for some continued moderation through the fourth quarter into early next year, as some of those unique factors that have helped support spending over the past year have begun to fade, like excess liquidity, easy access to credit, the things we've really been stressing in recent months. But if you continue to see this accommodation in financial markets and rise in some of these equity values and things like that can help bolster financials, I do get a little bit worried that we continue to see strength in the consumer. And I use the word worried because our forecast obviously calls for some contraction, but also what does that mean for the Fed in terms of policy next year? How does that translate to inflation? And where does that put the Fed in terms of when they're actually able to ease?
And where is that money coming from? Shannon, I spent the weekend thinking a lot about buy now, pay later, especially because that's hidden from a lot of the credit agencies. It's hidden from a lot of the other debt loads that people have, and yet it's accounting for almost 10% of recent online shopping during Black Friday and Cyber Monday. How concerned are you about the segment that's kind of flying under the radar?
Yeah, we're growing a bit more concerned about it, particularly because it's extremely difficult to measure. As you say, it's not gathered or tallied by credit agencies, and it's a little bit of a phantom debt is what we've been referring to it as. So it's growing more of a concern for us, particularly as households use it in terms of their holiday spending patterns. So I think that suggests that you might not be able to get as clean of a read on some of this high frequency data. So the retail sales data, for instance, last week came in above expectations, and that surprised us, particularly based on the BEA's high-frequency credit card data, so coming from the Bureau of Economic Analysis, which looked for a large decline. And part of that could be, using some of these buy now, pay later programs, which aren't being captured in some of that data. So we're growing more concerned. I think it's an area to pay very close attention to with the data we do have, and it just kind of puts lenders in a more difficult situation as well as they try to make some loans to consumers and maybe don't have the full picture in terms of their financial burden. So it's a growing vulnerability for sure.
So the next logical question for me, Shannon, do you think there is space, given what we do know, for the consumer to re-leverage going into next year?
So I think the leverage environment for the consumer is shifting in the sense that households have taken on increasing debt coming out of the pandemic after paying some down in the initial year or so during the pandemic. And I think we're in a more challenging position for households to continue to take on debt. Not only have banks tightened their standards at a pace that's consistent with recession, but interest rates are higher, which just makes it less affordable for consumers to continue to rely on that source of purchasing power. So our expectation is households are going to gradually pull back on some of more traditional debt components and rely more on their income. So for us, the trajectory is for that mild contraction that we have in the forecast, but it really depends on the labor market. If the labor market remains sturdy and you see a moderation without significant layoffs, I think households can continue to spend, particularly if their real income remains pretty sturdy. So the outcome really depends on the income as we think about the consumer for next year.
Where's the bigger risk right now, Shannon, in going into next year? Is it a rapid deterioration in the economy, or is it sticky inflation that doesn't get back to 2%, especially with a Fed that's easing or normalizing or whatever you want to call it?
It's tough to say at this point. I think it might be a little bit more of a deterioration. I think the inflation trajectory is very much in train. As I think about the Fed and how they think about easing, it's not necessarily the headline figures continuing to come down, because we are forecasting a continued decline in both the core and headline inflation metrics, but it's really going to depend on that composition, which prior to the last press conference, we heard Powell stressing in terms of that super core component, right? Getting that core services component lower. And while I think the risks to the outlook are pretty balanced at this point, I mean, we do have that modest contraction in the forecast. A rapid deterioration doesn't seem too likely, just because I think consumers are still in decent shape, and the labor market is showing signs of moderation, but not an imminent recession. So I think really the composition of inflation is going to be very key, and making sure that households are moderating their spending, but not actually pulling back to be consistent with the imminent contraction. So a little bit of a mixed bag.
Shannon, this was great. Let's do this again soon. Shannon Siri-Grind there of Wells Fargo. Let's take stock of the last 50 minutes or so, Lisa. It just seems that for many people there is a big difference between easing and normalization. And I go back to a question I've asked multiple times in the last hour or so. For financial market participants, is that a distinction without a difference? I don't think it makes a difference to many people.
I would agree, because essentially it's taking one of the potential headwinds off the table, which is a Fed that remains higher for a prolonged period of time, even in the face of disinflation. In other words, another leg of more restriction.
Are we going to hear more about this from Fed speakers? Just this kind of surgical rate cut story that Neil Dutter was talking about. When inflation starts to come down, you want to focus on real rates, not nominal.
Does it
keep
matter,
it consistent.
though? But to your exact point, does it matter?
I don't think for markets it does.
I think a cut is a cut, and if you don't have that potential pressure on markets, especially at a time where there is disinflation, people are going to view that as bullish.
You're always thinking about the next move, and if it's a cut, the one after that is a cut, because there is a belief that this starts a cycle of cuts.
And it also shows that the bias is not necessarily to remaining late to the party, that the transitory discussion wasn't something that was deeply scarring, that's going to make the Fed a lot more hesitant to cut rates, and that's a difference.
Let's speak to a man who wasn't late to the party. He arrived 6 months early and was waiting for everyone else to turn up. It was Jay Poloski at TPW. Jay joins us next on this program. Equity futures on the S&P 500 positive here by 0.1% on the S&P. Yields are doing nothing on a 10-year, but they've been doing something big time over the last month. Your 10-year, 3.90.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but where it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. Is there the kind of upside?
The message we got from the Fed was very much an all clear. The markets responded in kind.
This market is behaving in a way that thinks that rate cuts are absolutely imminent and that we're going to have this Goldilocks scenario. And I don't currently see that.
A lot of the drivers for higher rates haven't left the market.
There is some skepticism around how much is the Fed ultimately going to cut.
Whether it comes to the Fed's forecast being realized or the market expectations being realized, I think the truth in the end will lie somewhere in between.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Right now, the truth is whatever you want it to be in this financial market. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Your equity market on the S&P is just about positive by 0.1%, following 7 weeks of gains on the S&P 500. Chairman Powell started a rate cut party. The conversation was already going. The market's boozed up. And Mester, Williams, and Goolsby want you all to have a strong black coffee. No one's having it.
Exactly. Especially because right now the party keeps on going, and frankly, people feel edified about this idea of surgical cuts, whatever you want to call them. The Fed is done hiking rates. That's number one. That is quite clear. And number two, they're quite clearly preparing to understand what the triggers will be to start cutting rates starting next year.
My favorite quote, absolutely favorite quote of the last month or so, Jack Caffrey, JP Morgan, what a year November's been. So let's go back to November. You're publishing your outlook. You're feeling good about gains in 2024. And then November happens and you add in a little bit of December and all of a sudden you reassess and you think maybe we should put out a new outlook. David Costin, Goldman Sachs. Hello, sir. 5,100 on the S&P year end next year. Mid-November, 4,700. Lisa, they hiked their price target big time.
9% gain, I believe, from the original price target to the one that he put out about a month later. So what changed to have a more robust backdrop? One thing. The Fed was not going to be late to cut rates. that suddenly changed the game. That was one of the big risks for market participants, was that they were going to be preconditioned by the debacle of transitory. It turns out, instead of being preconditioned about some sort of shame with transitory, they are re-embracing it because maybe, hey, it's the truth after all. This, to me, is the game changer at a time where people were looking for excuses to be bearish and have none now.
Speaking of bearish, Mike Wilson, Morgan Stanley. Even Mike Wilson over at Morgan Stanley is getting into the festive spirit. Here's the quote. This is a bullish outcome for stocks, a bullish outcome for stocks. So let's go back to what Julian Emanuel of Evercore has been saying. Just how high have we reset the bar now going into 2024?
Well, this is a good question, right? And this is something that we are hearing more on the margins, that this is sort of a blow off top and that we're going to rally into year end and then the first quarter is going to be rocky. We've heard that from one person after another, including Michael Purvis, including a whole host of others. Julian Emanuel sees that as well, that next year is going to be rocky. It's going to be more of the same. But what's going to be the trigger? Is it going to be the cold water that Fed officials are trying to cast to this? I don't think so, because they're not doing a very good job right now based on the market reaction. Is it going to be the earnings? This, to me, is a question, or the cracks that maybe people are beginning to thinking about seeing.
Thinking about rate cuts as well. Is that where the Federal Reserve's at now?
I don't know. They were
but
saying
not talking about it. Just thinking about it. Okay.
It's a big difference.
Thanks for that clarification there. Let's get to the scores. This market's still rallying. Your equity market's positive on the S&P 500. It's higher by 0.2%. Yields are a little bit lower by a single basis point, 390 on a 10-year. In foreign exchange, the euro just about positive by 0.16% on that currency pair against the dollar, Lisa, 109.12.
All right, so this is what we're looking at this week. It's the last week of the year, basically, before everybody goes on vacation, or maybe it's just us. But here's the thing. Tuesday, the Bank of Japan rate decision, the thing that's sort of the sleeper issue that a lot of people were expecting, maybe they would move away from negative rate policies. Now people aren't thinking that it's going to be this week, but still. I mean, again, talking about potential tail risks, could this be something that upends some of the euphoria? Wednesday, Treasuries auctions don't matter until they do. The Treasury Department is selling $13 billion of 20-year bonds after that incredible rally. Does it hold after more than a percentage point of a decline in yield from the peak just about a month and a half ago? And Friday, to me, this is the other potential issue. What happens if the data doesn't cooperate with the euphoria of disinflation that we're seeing in markets? U.S. November personal income and spending comes out, as well as the core PCE deflator, which has been coming in, now about 3.4%. Does it keep coming in, or do we get sort of a plateauing? Neil Dutta says just the comps show that it will.
Lisa, thank you. That's your week ahead. Let's get straight to the conversation. Jay Pilosky has felt lonely all year, constructive on the equity market. Now he's got company, tons of company. The founder and principal of TPW Advisory joins us now. Jay, it's wonderful to catch up with you, sir. How good does that external validation feel for you this morning?
Well, it's been, it makes up for a warm, wet, and windy Monday morning in New York City. That's for sure. So, no, it's, you know, as you guys have been talking about, you and Lisa and others, markets have rallied. They've rallied right in your face. It's been very difficult to stand aside. It's the classic, as we talked about, year-end rally. You have a gate, a calendar end of the year. You're underperforming because you have cash. You have to participate. And I read something on in FinTwit over the week where it was like pain levels 10 out of 10, right? So there's a lot of pressure on people to perform in this period. And so there's a big chase going on. And as you see, it's continuing now into week 8.
Jay, you weren't bullish for the sake of being bullish. So let's talk about your framework, the process. You've been calling for this return to macro stability, away from what we've been experiencing over the previous 12, 18, 24 months. Jay, why are you still so convinced by that? And why is that the big outlook for you next year?
Yeah, I would say, John, it's actually been 3 years, right? We've been in 3 years since COVID of, you know, lots of volatility, you know, the inflation spike, the central bank response, all these things have manifested. We've had conflict, we've had climate issues. So it's been a period, the last 3 years, of macro volatility. And my view is that we're now exiting that period and we're entering a period of macro stability. All that stuff is in the background. It's all been, it's in the past, it's been priced in, it's been discounted. And going forward, I think the outlook is pretty positive. The Fed is done. We're moving from a rate hike cycle to a rate cutting cycle. We have economies that are doing reasonably well. The U.S. is growing this quarter at 2.5%, probably going to grow 2.5% for the year. Next year, consensus is 1.5%. it's quite likely that that's going to be revised up, as you talked about, people revising up their targets. Europe is bottoming. People love to bash Europe, but European equities have also been up 7 weeks in a row. And then you have China, struggling to get going on the traction front, but still growing at 5% per annum. So I think the negative outlook on things is just misplaced. It's been revealed to be misplaced by the market reaction. Market knows better than any one of us what is going to happen, and that's why it's forward-looking, and that's why you, in turn, have to be forward-looking. And so when we did our 24 outlook, we had 4 macro surprises. One of them, the first one, was lower than expected inflation sooner than expected. That's already playing out, and the market is reacting to that. Another one is a return to macro stability and the unlock that it can present in terms of all that money, well over $1 trillion that went into money market funds, can now start to come out. And that's why I think, well, the market is surely going to take a pause and surely going to pull back, and that's all good, natural, and healthy. There's so much money that needs to participate that I think that macro stability, the unlock of all that money that went into money market funds, provides a nice cushion so that I don't think you have to worry about a big downdraft in 2024.
You've been enthusiastic about non-U.S. stocks for quite a while, including European banks. You were early to this party as well. Now we are seeing that broadening out. How much more conviction do you have now than, say, 6 months ago that can continue?
Yeah, no, great question, Lisa. And look, our view, our framework has been very simple. We believe in keeping things simple. Lower inflation leads to lower rates, leads to a weaker dollar, leads to better outperformance outside the U.S. and good performance for commodities. Our Friday musings last week was titled Get Real, and the case we made was to get real means get real assets. And so we're really constructive on emerging markets, both debt and equity. They've been the huge laggard. No one owns them, completely underpriced, completely dismissed. We see big opportunities in EM around the regionalization of supply chains. This fits right, John, you talked about framework. Our framework is the tripolar world, regional deepening in Asia, Europe, and the Americas. And we're finally starting to see the opportunity to invest in that thesis with emerging markets, Mexico and the Americas, Poland in Europe, Vietnam in Asia, beneficiaries of the regionalization process. And then just to finish on commodities, commodities are the one thing that haven't participated. And yet, what is a big beneficiary of a weaker dollar and lower interest rates? Commodities. And so that's the opportunity as we see it right here. If you want to buy something now, you buy commodities. You buy oil, you buy copper, you buy gold miners, you buy ag. We're exposed across the spectrum. So our 2 big bets for next year, emerging markets and commodities.
Just real quick, can you take a page from Ray Dalio's book and say cash is trash at this point?
Cash is definitely a laggard, and that's what I said 6 months ago when everyone loved it. It's going to be a laggard. So yes, cash, you make 4%. Equities are up 20%. I would rather have the 20%. And so that's what's going to take money out of the money market fund and put it into risk assets as we return to macro stability in 24 and 25, in my view.
Very wise, Jay, because when people do call it trash, typically bad things happen. That was the right way, Lisa, to answer that question.
All right, there we go. That's called diplomacy. Although I will say that his note, I just have to read the way that it began. Wow, one has to admit that external validation, especially from a well-respected source like the Fed, sure feels good. This is someone who is definitely taking a victory lap after a really stellar year.
It's well-deserved. Jay, enjoy the Christmas holiday, sir. It's good to catch up. Jay Pawlowski there of TPW on the latest. Just on energy, what he had to say there on some of the laggards, really important. We've seen this rally broaden out big time, beyond big tech. The banks have absolutely ripped off the lows of October. Since the end of October, the S&P 500 is up something like 12.5%. Energy stocks on the S&P down 2%. That's where the underperformance has been.
It's because we've had, 7 straight weeks of declines in oil prices. I think that we eked out a bit of a gain last week for the first time in quite a while. But this has really been a surprise, and it's really on the heels of shale production in the U.S. And so at what point can you really game out the trajectory when it's affected by supply that people hadn't been counting on before.
Producing more than 13 million barrels a day in the United States of America. If you are just joining this program, welcome to this program. Your equity market's shaping up as follows. Positive here by 0.2%. Yields a little lower by a single basis point at 389.97 on a US 10-year. In the FX market, 109.13 on the euro against the dollar. Positive there by 0.2%. Crude is rallying. I can tell you nat gas is as well in Europe too. I want to sit on this story and we'll build on it with Anne-Marie in just a moment. BP is pausing all oil tanker transits through the Red Sea. We heard a similar story from Maersk at the end of last week. The announcement, of course, following an escalation of attacks on ships by Houthi militants. Lisa, this is one to watch. It's building gradually over the last few days.
Since December 15th, 4 of the world's 5 biggest container shipping companies have paused or suspended their services in the Red Sea. Just to give you a sense of what else is happening around the world, in addition to oil tankers that also are not passing through there. What does this do to the price? What does this do to the geopolitics if the U.S. is saying, we got to stop this to keep shipping going, and they can't get an agreement with other Middle Eastern allies? This is a very difficult moment, especially at a time that's pretty tenuous in the region.
This is 12% of global trade. It's no doubt important. We'll keep building on this story with Anne-Marie in about 5 minutes. Later in the hour, we'll catch up with Elliot Ackerman on the nature of the war. We'll get to that a little bit later. Then on the markets, Mira Pandit of JP Morgan Asset Management will kick off the next hour on Bloomberg Surveillance. The next hour, about 47 minutes away. Let's sit on the price section right now. Equities lifting again on the S&P 500 by 0.25%. The run has been absolutely phenomenal. 7 weeks of gains on the S&P 500, the longest weekly winning streak going back to November 2017, encouraged by Chairman Powell. As for the rest of them, we're just going to ignore them. The pushback from Goolsby, from Mester, from Williams. Apparently this market does not care. More on that a little bit later. From New York, good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How close is the Senate to any sort of deal on the border that would then also allow Israel and Ukraine funding to pass?
Well, let me just say this, that I have been communicating with the negotiators, my colleagues and friends on the Democrat and Republican side, also with the White House, too, and I'm very encouraged. I'm very optimistic. They're moving in a very positive way. They understand that the border is broken.
The border is broken, wide open, some might say. That was Senator Joe Manchin of West Virginia speaking on CNN, seeing optimism in a potential border deal, a solution, if you will. There's still work to do in Washington. There's still work to do in the Middle East. The latest story coming from BP in the last hour or so, pausing all oil tanker transits through the Red Sea. We heard something similar from Maersk going into the weekend just last week, following an escalation of attacks on merchant shipping by Houthi militants. Let's get some clarity on the story. Anne-Marie joins us down in Washington, our chief Washington correspondent. AMH, let's go there. How tricky is that situation going through the Suez Canal currently?
Oh, well, it's incredibly tricky now that they've pulled this transport through the Red Sea, because now they're going to have to use more tankers. They're going to have to go around the Horn of Africa. So the fact that they did this, the fact that this is going to create more issues for their supply chains, more issues for their fuel consumption, you have to imagine that they are very concerned. Now, the Biden administration is, of course, weighing what they can do when it comes to these Houthi attacks. Do they potentially go directly after the Houthis? One source I spoke to this morning is talking about the fact that within the Biden administration, there is debate about potentially getting involved in a longer-term, protracted Houthi potential conflict. There also is talk of maybe a maritime consortium to be there in the Red Sea to protect it. So these are the active conversations happening right now. We should note we have seen a lot of diplomacy within the region. The president's national security advisor, Jake Sullivan, was just in the UAE. We also have today Lloyd Austin in the region. He'll also be going to Israel. So there's a lot of discussions from the White House and the Defense Department about what to do regarding the Red Sea and these critical shipping lanes.
People have been talking also about disagreements within some of the U.S.'s Middle Eastern allies about which factions to support and how to best counter the Houthi militants. How much credence do you put into those stories?
Well, I think at the end of the day, because the Saudis and the Emiratis are going to want to make sure that it is a safe and secure region, they'll come to an agreement, but they just support different parts of the factions in Yemen. But I think really at the end of the day, it really comes down to what the United States' plan is going to be in the region, and then the potential to be able to get Riyadh and Abu Dhabi on board.
You mentioned that Lloyd Austin is heading to Israel. He is the Secretary of Defense, and he is expected to go there with a message, start moving to a new phase of war that is more targeted with individual units that are much more specialized going in for select targets. How big of a shift is this, and how urgent is this message, and will it even be heard?
Well, already the message has come from the White House to Prime Minister Benjamin Netanyahu and to the Israeli government that they need to start winding down this war in weeks. The New York Times reported the end of the year. My own reporting is a little bit more closer to the middle of January. They want this war over. And when you have to look at what is going on in Israeli own reporting, I mean, there was an issue over the weekend where the IDF actually shot and killed Israeli hostages. So it does look like there is an immense amount of pressure building from the foreign community, now also the United States on board, for the Israelis to start winding this down. The Palestinian death toll now is north of 18,000 people. This is incredibly devastating and complicated for this administration as well. And Lloyd Austin is going to be there to be another voice to add that pressure to the Israeli government.
Anne-Marie, let's talk about that pressure. Is it building domestically within Israel as well?
Well, there's a lot of concerns within Israel about Benjamin Netanyahu. This has been growing since even before the Hamas war started, before Hamas's terrorist attack in southern Israel. There has been a lot of concerns about Benjamin Netanyahu, where he wanted to take the government and their democracy with the judicial overhaul. And now there's a lot of concerns within the Israeli people about how did this happen and the security concerns. So there's a tremendous amount of pressure building on that government, as well as people who want to make sure that about civilian lives not being lost, especially those Israelis that are still in Hamas's control in Gaza. They want to make sure that these individuals can come out alive and safely.
It's absolutely tragic. Let's just finish on this for the president. How much are his own polls dictating how he approaches this foreign conflict?
Not even sure if this is in the polls, Jonathan, because the polls continue to show that it's not really foreign policy that American voters are concerned about. It's the economy, and across the board, whether it's inflation, whether it's interest rates, Americans think former President Donald Trump would have a better handle on the economy. But when it comes to the youth vote, our polling has showed that they want more to be done for the Palestinians in Gaza than what the U.S. government is currently doing. And you have to remember, the youth came out in pretty big numbers for President Biden in 2020. Will they do that again come November?
The head-to-heads for the president don't look good, Anne-Marie. Just to wrap up with a poll from Fox over the weekend, hypothetical general election matchups against President Biden. Haley ahead by 6 points, Trump's up by 4, DeSantis is tying. According to Fox, as recently as August, Biden was narrowly ahead of all 3 of them. Just going back to late summer. Anne-Marie, we've discussed this a few times, just the arc of this conversation. Initially, the White House pushed back against the importance of these polls. Are you hearing the same thing now?
Of course, they're going to push back against the importance of these polls. They're going to say we have 11 months still to go. And they'll also point to the fact that everyone was talking about a red wave when it came to the midterm elections, and that did not materialize. But the fact of the matter is, you are seeing the president do a lot more fundraisers. He's sitting on a massive war chest that they haven't quite put to use yet, but that is certainly going to ramp up, really, as we turn after the Christmas holidays. We go into Iowa, we go into New Hampshire. All of that campaigning and where they decide to deploy that money, all likely the swing states, that will start to ramp up. But obviously, for the campaign, when they hear these numbers, it is challenging because it's not just one fluke poll. It's poll after poll after poll. Potentially, though, and we've talked about this last week when Jay Powell did a little bit of his pivot, Jonathan, after you mentioned 12 days. The timeline may be on this administration's side. Inflation is coming down. They still have an unemployment rate below 4%. And potentially, they're going to have cuts at the Federal Reserve next year going into November.
And the two are not connected in any way, shape or form, we're told. Anne-Marie, thank you. AMH down in Washington, D.C. It was quite a change. Got people asking a question, at least, over the last couple of weeks. Lisa, put it together. You've got inflation coming down. Unemployment still around 4, which is historically tremendously low. You've got the Federal Reserve set in the minds of many to cut interest rates. Equity market absolutely ripping. You'd think the economy was doing pretty well. And then you look at the polling, number one issue is the economy for Republicans. Number one issue is the economy for Democrats. And yet we've got a president that is increasingly unpopular, not becoming more popular by many measures.
And a Wall Street Journal polls that directly they feel like President Biden's policies have made them less successful and have hurt them personally. More and more. Even Democrats think that. More than half of voters say that they hurt them overall for the general election. This is the opposite from the former President Trump. So how does he really change this? Is this a messaging issue? Is this something with respect to inflation and the image of that? Is this something else? Is it just sort of a lack of a clear kind of policy going forward? I'm not sure what the answer is.
The Federal Reserve is going to want to steer clear of this whole conversation. I think we should all be clear about that. At least they're going to attempt to in the minds of so many. Mark Zandi of Moody's had this to say. Our story over the weekend was brilliant on this. Here's the quote. Powell doesn't want to be Comey. As we approach the election, the bar for the Fed raising or lowering rates is probably pretty high, which makes you think maybe it's not a second half story. Perhaps this is going to be a first half story.
Maybe that's the reason why they want to get it out of the way. Honestly, I just have to go to this. I was reading a number of stories about the youth vote because the difference between the youth vote and the rest of the population is just shocking to me. It found there was this recent Harvard-Harris poll that found that the majority, 79%, of college students, 18 to 24, 79% think that white people are oppressors and non-white people have been oppressed. And you could say that Jews as a class, 67% are oppressors. That's according to age 18 to 24. The ratio of Democrats to Republicans is about the highest among faculty at universities ever, going back to the 1800s. There are a whole host of polls with different groups, both Democratic affiliation and Republican affiliation, putting this out, and it has the same kind of feeling. There is a very, very big gap that is emerging.
This is the worldview that has come out of this education system in the last decade. That's it, bottom line. And you're starting to see it in measure after measure. From New York City, good morning.
the reception, the acceptance of Puro Sangue has been extraordinarily high. We had to stop the order for a while because we had to understand how to manage the supply chain. So there is a strong traction of Puro Sangue all over the world.
How much do you worry about increasing production and therefore becoming, I guess, less high-end luxury?
We are making 13,000, 14,000 cars per year. We will not grow a lot in the future because we want to grow more for value, not for volume. And maybe one number, you know how many cars Ferrari did we put on the road since the beginning, since the first one? 250, 260,000. So 250,000 cars in a market where there are million and million of cars every year.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
This equity market has been absolutely flying. 7 weeks of gains on the S&P 500. That winning streak could become 8. On the S&P right now, equity futures are just about positive by 0.2%. On the Nasdaq 100, up by 0.1. Since the end of October, the S&P is higher by more than 12%. The banks, the financials on the S&P 500 are up by more than 20. The regional banks, some of those on the Russell, Lisa, they're absolutely flying.
And you raised this question, are rate cuts good for banks or are they bad for banks?
Apparently they're good for bank stocks now.
They're good for bank stocks because they're taking a tail risk off the table or because they're coming in response to a tail risk?
The latter, not the former.
Okay, well, these are sort of the questions that we have to ask to understand the logic behind some of the investment decisions, or is it just sort of a FOMO, lean in and feel good?
No, these names got absolutely beaten up by the rate shock at the start of the year. There was a big worry about what they were carrying, a big worry about what it would mean for their future. We were talking about existential crisis type stuff, and now rates have come down. But I'm with you, it raises an important question. If you sit down with me at the start of 2023, I think we're all saying higher rates, steeper curves, great for banks. Now I don't know anymore going into 2024.
Especially because a lot of the landscape has changed. And I would like to understand a little bit better the buy now, pay later, how much of the consumer debt is moving to alternative methods of financing away from the banks that haven't been as quick to lend in an environment where they have such big portfolios of treasuries and have been hampered by these concerns. But we've seen the private investment firms take over a lot of that kind of activity.
Let's turn to treasuries, 2-year, 10-year, 30-year, just shaping up as follows this morning at least. Yields pretty stable, given everything we've seen over the last couple of months. We're down a couple of basis points on a 2-year, 442, on a 10-year, 390.72. I have to say, Lisa, even with the moves we've seen, you have to think about this. End of cycle dynamics typically leads to a bull steepener, which means the front end of the curve rallies hard, starts to price in a rate cutting cycle. Haven't really seen that. The 2-year versus the 10-year is negative 50-something basis points. Priya Misra of JP Morgan talked about this, and I think it's important. The difference between easing and normalizing, with a focus on real rates here. For the market at the moment, I think that is a distinction without a difference. For the Federal Reserve, I think it's increasingly important. We're talking about maybe cutting in line with the fall we've seen with inflation, but perhaps staying above what might be considered neutral. Now, with that in mind, you have to think about maybe the curve responding differently to what you would expect if it was end-of-cycle aggressive cuts.
It also implies there is a longer time frame with which this Fed is comfortable with getting inflation under control. They're going to extend the process. They're not as worried about getting it under control as quickly as possible. And rather, they're more prioritizing the soft landing and let it go for a long time.
We've got a great guest on this conversation coming up in just a moment, so sit tight. Under surveillance this morning, Israel pushing back against calls for a ceasefire in its war with Hamas. The foreign minister saying ending the fight would be a, quote, prize for terrorism. Israel facing increasing pressure with UK and German officials urging for a, quote, sustainable ceasefire, followed by the French foreign minister calling for, Lisa, what they're calling an immediate and durable truce.
And a lot of this has to do also with Hamas putting down their arms, right? So there's a lot of questions, but you raised something really important recently, which is that there's a lot of disagreement within Israel itself, and that Netanyahu is not a popular president right now and has some, particular views that are really polarizing a lot of the population, particularly because people want the hostages to come home. And they want them to come home alive, not dead, the way that a number of bodies have been coming home. And so this is some of the tension bubbling under the surface at a time where everybody wants to see aid get into people and families that are living in horrific situations in Gaza.
We're starting to see the business consequences come to the surface as well. This from BP this morning, pausing all oil tanker transits through the Red Sea. The announcement following an escalation of attacks on merchant shipping companies by Houthi militants. Maersk making a similar announcement on Friday. Important always to quote the fact that 12% of global trade depends on the Suez Canal, and that journey, Lisa, is going to get longer unless they address this and address it quickly.
To me, this is a massive issue, and it's something that has legs and potentially could really have consequences, not only because of the shipping and the potential supply chain disruptions that we thought were behind us, but also, does the U.S. get directly involved? Do they send aircraft carriers over to the region? Who do they work with? How do you get on the side of different factions that are definitely at odds? These are all real questions at a time where there are two other fronts to this conflict that are going on right now in the world.
Less serious story. Have you got a drink ready?
I do.
Drinking game, you know the buzzword.
Yep.
Pushback, pushback. Fed officials pushing back on rate cut talks early next year.
Because of it.
New York Fed President John Williams speaking to CNBC, saying those discussions are, quote, premature. Atlanta Fed President Raphael Bostic speaking with Reuters, saying cuts won't start until the third quarter of 24. And Cleveland Fed President Loretta Mester this morning warning the markets are a bit ahead of themselves in an interview with the Financial Times and Colby Smith. Here's the quote: markets jumped to the end part, which is we're going to normalize quickly, and I don't see it that way. Lisa, that's sufficient for you?
Well, it's not sufficient for the market. I think it doesn't matter whether it's sufficient for me. I think that there's this issue of what would it take for them not to cut rates at this point? And not to cut rates in March, especially if, to your point, they want to avoid some of the political influence heading into the end of the year. This, to me, is the real question. It seems like the next step's going to be a cut, so what's the threshold? And that, I think, is what's unclear.
Invesco's Matt Brill joins us around a table. Should we start then, Matt? And good morning to you. Good
morning.
How credible is the pushback from Mester, Goolsbee, Williams after what we heard from the chair of the Federal Reserve on Wednesday?
Well, I think Powell himself had the chance for pushback in his speech, and he didn't do it at all.
Didn't do it.
So to me, that was really what you needed to hear. And from now, they're going to have to push back a little bit because it has been an absolutely enormous rally here, and they're pricing in a tremendous amount of cuts, and the financial easing that has gone on could call into question things. But I think overall, the inflation is on the right path, and they know it.
You were bullish credit before. Are you more bullish now?
I started to get a little bit weary of it, and I actually was on the show last time with Lisa. She said, "Are you actually adding while everybody else is cutting right now?" And I thought about it for a second. I said, "Well, I think 2024 is setting up really, really well. I didn't think we'd get it this quickly, though. I thought there would be a lot of companies that were pushing back on borrowing because it was so expensive. They were borrowing at 6.5% to 7%, and they didn't want to do it. Now they're going to be borrowing at 5% to 6%, and it's a little more tolerable." But I think overall, the technicals are going to be very good. We've talked about this wall of money coming out of T-bills and cash. That is absolutely going to occur. And with it, fundamentals are very, very good.
So are you more interested in investment grade, or are you going even into lower rated credit because you see, if there's going to be spread compression, well, join the party?
I think there's a party in a lot of different places, right? So I think it's all about your risk tolerance, but certainly continue to see upgrades in 2024. I think the high yield double B market looks very good. The triple B market, the fundamentals are very, very sound. And so overall, I think you can go down. I think if you look, still the triple C sector is challenged. I think it's had very good returns, but there are some landmines there. So overall, I just think that there's a lot of good opportunities, but where there are most is actually in the banks.
In the banks.
In the banks. So if you look at valuations, the financials are kind of in their 60th percentile cheap versus the industrials are at their 10th percentile. So there's not a lot of value on spread in industrials, but there's a lot of value on yield and on spread in the banks.
I'm just wondering how much this is dependent on the Fed following through with rate cuts in March. Is there sort of a feeling that if they do, this all works out, and if they don't, it kind of starts falling apart?
So March is probably not that important. How many times do they cut in 2024 is. So I think just if they go in May instead of March, or whatever, the summer instead of March, it matters a little bit. But I think it's all about just getting that that signal from the Fed that they are going to be there if they need to be, which we didn't have before. We were worried about that last mile, that the Fed was going to fight so hard for that final mile to get inflation from 3 to 2. Now they're telling you we're going to get there, but we'll do it at our own pace, and we're not going to wreck the economy in order to do it. And I think from a banking standpoint, that's very good, because they were probably going to take the brunt of it if the Fed really did push for that final mile.
You've touched on this a little bit. Let's build on it. You talked about that wall of money. Can we talk about that wall of supply? What's going on with that wall of supply?
So the wall of supply, there actually is a fair amount of securities coming due this year in the investment grade market, as well as high yield. But a lot of companies have elected to simply roll that, or not roll that debt, and actually just pay it down with cash. So because it's expensive to borrow, you're seeing less debt. So net debt issuance in IG in 2024 is going to be the lowest it's been in like 5 years. So that's a huge technical positive. Now, if rates get low enough that more companies want to borrow, that'll be a little bit of an offset to that. But we are projected to see a significant decrease in net supply. 2025 is kind of when it starts to pick up a little bit more, so we're kind of looking out towards that. But overall, one company that I'm watching for the signal, if you want a signal to keep on your radar, is Microsoft. They bought Activision for $70+ billion. They didn't borrow a dime from the investment grade market. They borrowed like 30 or 40 billion from commercial paper. They have not termed it out at all because it's too expensive. If Microsoft taps the market, they're telling you we no longer think it's that expensive. That means you're going to see a lot more supply coming.
We've seen equity finance deals elsewhere in M&A as well. Is that supportive of what we've seen in credit? Has the approach to the credit market changed because of where rates are currently?
I think so. So a lot of the first two big M&A deals in the energy space, the Exxon and the Chevron, were both equity financed. You just had Occidental, though, say that they're going to be borrowing to do their recent M&A deal. So we're seeing a little bit of a balance there, but overall, when debt is expensive, people want to borrow less, or they should want to borrow less, and so far we've seen that. I'd be concerned if we start to see the trend move the other way, and people just say, you know what, 5.5% is not that bad, because for a while there, they would have been kicking and screaming at 5.5%, but when you got to 6.5 to 7, it doesn't look as bad anymore.
I can't believe Tom's not here. He's been asking everybody, every credit person who comes on, when are big tech going to start issuing bonds? Literally every single person. He's not here today, and you're like, well, watch for Microsoft to start issuing bonds. He's probably watching and incredibly excited. So you think that could unleash a significant amount of supply that could maybe be not as positive?
It would be a signal to me. I'm not expecting it, but if I do see that, Meta did borrow. Look at the coupons on a lot of these deals. You look at Google, they've got 2 coupons. You look at 2% coupons. You look at Meta, they're at like 4% coupons. Nobody in the tech world issued at 5, 6, 7%. If you start to see anybody issuing at 5, it tells you that the high quality company that has cash is no longer thinking it's that prohibitive. But again, we haven't seen it yet, but that's the signal we're waiting for.
Has there been a bias to shorter dated maturities?
Absolutely. So there's been about 15% of 30-year debt has been in 30-year securities or longer. Historically, that it had been as high as 30% just a few years ago. So companies did not want to borrow at these rates for a long time. Everybody forgets companies cannot prepay this debt. It's not like your mortgage. You can just refinance it and say, you know what, I borrowed for 30 years. The rates have gone down. I'll roll it right into a new lower rate. They have to be stuck with that for a very, very long time. So companies don't want to borrow these rates, and a lot of pension plans and insurance companies are really starting to step into the market, and they have been for the last 6 months. Retail is finally getting on board, but it's really been the pension insurance companies been buying the long end, and that's been flattening credit curves.
Well, this is what I wanted to ask you. Help me. I'm in cash. I'm asking this for TK. I'm in cash, and I need to deploy some of it. Where do I go? What are you telling people?
Well, it's been a good trade, is what we keep telling people. But until recently, until the last month, we always have to say it's been a good trade, but you got to find the next good trade. And I think it's kind of, do you need to crawl before you can walk? If that's the case, you got to go 2-3 years. 2 to 3 year corporate debt is really attractive, particularly in the high yield market. That is getting gobbled up. We think that that's going to just completely collapse here. 2 to 3 year debt is very, very safe, but go out to 5 to 6 year debt. If you like the rate for 6 months, you ought to like it for 6 years.
There you go, Bram. Bottom line. If you like it for 6, you should like it for 6 years.
That sounds like you've given that speech before a couple times. That sounded very prepared.
I imagine that's what the call is like with clients at the moment.
Pretty much every single one.
Reinvestment risk.
Exactly.
Heard it from Priya Misra too at JP Morgan.
You've got to crawl before you walk. If you want short dated, you got some nice stuff.
There
then you can push further.
Just kind of counseling people into
exactly.
taking additional.
And no one listens.
Feels like therapy. That's the kicker.
Matt, thank you, buddy. It's great to see you. Matt Brill there. of Invesco. If you're just joining us, welcome to the program. Your S&P 500 looks like this, positive by 0.2%. Yields are going absolutely nowhere, 390.90 on a US 10-year. Tons of Fed speakers, sprinkle of data. That's your week ahead, but for many, Lisa, for many, it's year over.
It has been year over for a while, but honestly, things can happen, right? I mean, the pushback could matter if suddenly we get a data print that confirms it. We get core PCE on Friday. The Bank of Japan, suddenly no one cares about the Bank of Japan anymore. That's tomorrow. We've got a rate decision. What if they just abandon negative rates? They surprise everyone. They throw in the towel.
I have to say, if the data worsens, and I mean really worsens, you get that ugly payrolls print, that's where you have a different conversation. Prime Minister of JP Morgan was right to say that this market is pricing normalization. Rates coming back to what the Fed might perceive as being neutral, somewhere in that range. We're not talking about end of cycle. We're not talking about recession and aggressive rate cuts off the back of bad data. Quite the opposite. The hope, the dream is that the economic output, the economy remains okay, inflation continues to come down, and this Federal Reserve can cut interest rates in line with that progress.
And we heard that from Steve Chivarone, the idea that even if we get a sort of soft recession, profits can still hang in there. Companies can still do okay because consumers keep spending. If something shifts that narrative, that could make a real big difference.
That right there is the dream. The problem is the price of that dream is getting more and more expensive as each week passes us by. This morning, stocks are up by 0.2% on the S&P. On the conflict in the Middle East, up next is Elliot Ackerman, U.S. Marine veteran, on the latest in that war. From New York City, this is Bloomberg.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Let's start with the border.
Sure.
Do you think there's going to be a deal before the new year?
No, I think this will go into next year. According to the FBI director, since October the 7th, jihadist groups want to attack us because we're helping Israel. I've never been more worried about a 9/11 than I am right now, and our border has been obliterated. I will not help Ukraine, Taiwan, or Israel until we secure a border that's been obliterated.
That was Senator Lindsey Graham of South Carolina speaking on NBC over the weekend as the White House and Senate worked to secure a deal on the border with supplemental aid to Ukraine and Israel. This is important for obvious reasons, but politically speaking, Bramo, just looking at the polling, number one issue for the Republicans right now, economy, in line with Democrats, where you see the split, the southern border. That is a very close second, according to a Fox poll over the weekend, as a number two issue for Republican voters.
Which is a reason why this is the main sticking point to getting aid. It's also interesting, though, there are a growing number of Democrats who are getting on board with it. But again, I go to that schism in the Democratic Party, because does Joe Biden lean into some sort of deal at the risk of angering the Progressive Party, which he needs to win the general election, or at least win the primaries.
Well, the questions around the two wars, Lisa, we know the obvious factions right now. You've got Democrats questioning aid to Israel. You've got Republicans questioning aid to Ukraine. And then you've got a push to get some border aid into the mix as well, all going into year end with two key deadlines on the horizon, one in January, another in February, to secure some kind of spending deal.
And real wars being fought, and people looking to understand what the strategy is. And I'm thinking in particular of Ukraine, where a lot of people are saying that Russia will have a much bigger advantage if Ukraine doesn't get the aid that they're asking for.
Let's talk about the other war, the war between Israel and Hamas. Elliot Ackerman joins us now, the U.S. Marine Corps veteran and former White House fellow. Elliot, you've got experience of this. It's valuable to us to lean on it, so thank you for joining us again. The door-to-door combat that we're seeing take place in Gaza, the fog of war, so to speak, and the tragic loss of life, both civilian loss of life and what we saw in the last few days, hostages losing their lives as well. Elliot, can you talk to us about the nature of combat right now and how on earth these things happen?
Well, the one thing I think is worth emphasizing is it's very difficult to overstate how chaotic this type of urban combat is, how difficult it is in certain situations to know exactly what's going on. So obviously, you know, this incident where these 3 hostages were killed is a tragedy. You know, it's important to also just bear in mind the context in which it's happening, in which these Israeli soldiers have now been fighting for weeks, house to house, room to room in Gaza. You know, I fought in the Fallujah battle in 2004, and oftentimes, you know, it can be difficult in the heat of the moment to know, you know, who's a friend, who's a foe, even when someone would appear to be surrendering. I actually have a friend of mine, Dan Malcolm. I wear a bracelet for him. I've worn this bracelet for 20 years. And he was on a rooftop, and about 30 minutes before he was shot dead by a sniper, a group of individuals who we thought were civilians looked like they were trying to surrender. In fact, they weren't civilians. They were insurgents posing as civilians. They were trying to surrender so they could figure out where our positions were. Now, this doesn't excuse what happened in Israel, but I hope it just gives a little bit of a context for the types of conditions these soldiers are dealing with.
As you know, Elliot, in the court of public opinion, accidents don't seem to mean anything. It's the loss of life that is important. Elliot, there is pressure building to end this war, and quickly. And what we often hear about is time. How much longer can it go on for? I think you draw a really important distinction between time-based policy and condition-based strategy on the ground. Why is that so important, particularly for this conflict and for where this administration in America stands on it?
Well, I think we've seen in the past that this administration has gotten itself in trouble when it's leaned on times-based conditions, and I'm speaking specifically of Afghanistan. You know, when we pulled up on a calendar that wound up not making sense on the ground, and I think in the case of Israel, you know, the objective of the Israeli government, as they've stated, is the destruction of Hamas. If you pull out before that job is done, you know, it's basically analogous of, you know, if you had cancer, finishing your chemotherapy when you've only got 95% of the cancer, it's going to metastasize and grow again. So in my old business, the military business, we had a saying, which is you don't ever want a gentle surgeon. When you will go in to get these jobs done, you got to get the whole job done. You don't necessarily want to do it gently because you can wind up causing more damage than if you just get it done decisively. So, and I'd also just point out, it's sort of strange to see this juxtaposition of needing the speed and needing this finish and demanding that it be finished within days and weeks in Israel, while seeing sort of a willingness to allow the war in Ukraine to kind of just drag in year over year over year. So I think it's important to also keep those two in our minds.
Is Lloyd Austin a gentle surgeon?
I don't think Lloyd Austin necessarily is a gentle surgeon, but I think what the administration is calling for by saying, let's just finish this in this pressure campaign, is basically asking Israel to engage in gentle surgery. I don't think Israel is going to, frankly. I think that there is a level of resolve there that we can't completely appreciate in the United States, but I think there is a danger there that if they were to end this fight right now, when it's mostly done but not all the way done, that this would just wind up being an even worse conflict because they're going to start fighting it again, you know, months or years down the road.
Elliot, you're one of the best voices we could talk to because you can appreciate what it is in a region like that that is engaged in hand-to-hand combat and that has been going on for a while. The civilians, and this is sort of one of the big fears, is that the humanitarian crisis is getting incredibly difficult to deal with, and you cannot get aid in if there is active combat. Is there any corollary to this moment where there could be some way of assisting civilians while continuing the campaign that you see Israel continuing?
Well, I mean, this gets down to the particulars on the ground. What areas are safe? Are there areas that the Israelis feel they've sufficiently cleared out of Hamas fighters where they could allow civilians to come back into those areas and get aid to them? And hopefully we can start to maybe see something like that where Israel has areas that they feel they can control. But they shouldn't be forced to do that before they're ready to do it. At the risk of having to go fight this fight all over again because Hamas is a determined adversary. We've seen that. We've seen now the images of these tunnels that are wide enough to drive cars through. Hamas is determined to destroy Israel, and Israel, I think appropriately, is determined to defend itself and make sure that that can never happen.
And if you looked at financial markets, it's as if nothing's really happening. I think there is a belief from investors that this conflict will remain contained. And yet there are some cracks in that theory when you start to see attacks come from Houthi militants on foreign shipping companies, and foreign shipping companies start to think about pausing the use of the Suez Canal. I just wonder, Elliot, how convinced you are that this particular conflict will be contained to where it's playing out right now?
It's less that I'm convinced that the conflict will, in all cases, be contained. And we've seen that it hasn't necessarily been contained, right? We've seen attacks on U.S. troops in Syria and Iraq from Iranian militants. But I think what probably gives individuals confidence and gives me confidence is that if it starts to really overflow into areas that are problematic, the United States and its allies have the capacity to quickly contain the conflict. That the U.S. Navy goes up against some vessels from Houthi rebel groups, the U.S. Navy is going to win. But, we don't want it to get to that point. And I think in addition to what's going on in Israel, the U.S. Department of Defense and the Biden administration is very, very closely watching these other events in the region.
Just quickly, Elliot, how much does it change the game that this is essentially the first war that's been live streamed?
Well, I think the game in so much as tactical decisions, things that happen, on the ground are immediately projected out to the entire world and have strategic implications. And we saw that recently with the deaths of these 3 hostages. We've seen that, but not only in Israel. I mean, we've also seen that Ukraine is a war that has been a social media war, as was Afghanistan. And so really in the last handful of years, the political calculus of war has changed because, as you just put, these wars are live streamed, they're run over social media, and we all experience them.
Elliot, thank you for the update. We appreciate it. It's, as always, Elliot Ackman then, leaning on his personal experience in Iraq and elsewhere. Lisa, just incredibly difficult door-to-door combat and the accidents that can happen. If you think about the objective hasn't changed, destroy Hamas. Where there is massive disagreement, the means to achieve that objective because of the tragic loss of life we've seen over the last few months.
I talk about social media and I talk about the idea that the images are streamed because it does change the political calculus and it does change the sort of groundswell of opinion. If this had been fought 20 years ago, do you think that you would have the same kind of feelings? What wars are shown more than others? There are a lot of things like that that are going on, and the court of public opinion is one that seems to be a pretty significant one for Hamas. And it's sort of a question of how you deal with that.
I couldn't agree more. Coming up on the market, Mira Pandit at JP Morgan Asset Management joining us on this rip-roaring rally of the last 2 months. Your equity market positive here by 0.2%. Yields in the bond market just a touch lower. Your 10-year 390.53. From New York City, pushback. What pushback? This is Bloomberg.
From a mining company, which frankly is dirty, it's big, now you want to reposition the company into green energy powerhouse. Are you a walking contradiction, or what did you learn along the way?
Well, in the early days, it was considered completely impossible for anyone. Doesn't matter if you're a huge company, like back then it was Anglo American tried to break into the iron ore industry, and they spectacularly failed, even though that back then they were the largest mining company in the world. Now, for an upstart, a tiny little company with next to no cash at bank, no ground, no anything, for them to announce that they were going to break into the iron ore industry, the global seaborne iron industry, probably the most protected, viciously protected resources industry in the world, and then take them on head on, it was just considered impossible. It was just like a fairy tale. However, we stuck to the plan. We always tested each other by making sure that we were starting where we wanted to finish, which is as a major iron ore producer. And then we took all the steps back. We calculated what the steps would be, even though some of them seemed impossible. Now we have a strategy, and we've got to go flesh that strategy out and pursue it with single-minded focus.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
There's so much optimism in the markets right now.
We've always counted on markets overreacting.
It seems like the market's in for a bit of a consolidation here.
We are in an environment where there is less rate sensitivity.
For the here and now to the year end, look, I think 4,800 is a real scenario here.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The bears have been absolutely crushed over the last 2 months. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Your equity market positive by 0.25% on the S&P on a 7-week winning streak on the S&P 500, the longest weekly winning streak going back to November 2017. For financial markets, Christmas started at the end of October.
I thought you were going to say, let's get you to the weekend, because it kind of feels like people are ready for it to just go away at this point. Honestly, we're looking at a situation where we're seeing the longest rally since, 2017 in the S&P. We're seeing new all-time highs in the NASDAQ. People are feeling euphoric around every asset class. Where is the pushback to really create the feeling that the bears are even heard? I mean, I'm sorry, forgive me, but think a prayer for the bears that have been blown out of the positions and aren't going to really restart it. Does that mean that there's sort of this downside risk, that there isn't that contrarian voice in it?
What bears? Mike Wilson, Morgan Stanley, he sounds bullish this morning. Who's left? What bears are left?
That's my point. If you don't have any bears left, don't you have a problem on your hands? You need the bears.
The bar is very high now going into 2024. So let's talk about the bear. Inflation comes down, growth is still okay, and this Fed is cutting rates and earnings rebound. Is that right? Is that the bet into next year?
Basically, and we heard from Jay Pulaski, we might get some turmoil. People are talking about, some sort of top off, blow up of off the top for a little bit, but everyone's talking about buying the dip. I mean, this is what we heard earlier this year, right? That basically any dip is a buyable dip, and then we didn't get a dip. Is that going to be the same kind of repeat that we get next year?
Never mind getting to the weekend. Let's get to the year end. If you've put out a price target a month ago, wow, it's painful. David Costin at Goldman Sachs out first, revising the call for next year that he'd only made a month ago on the S&P 500. They go from 4,700 to 5,100. I keep saying it. We've had next year's gains in 2 months for many of these houses, many of these banks.
And they see no reason for it to stop, and I think that's the important thing. Some people are saying, including Julian Emanuel of Evercore ISI, who came out and said, we don't think you're going to get that big of a gain through year end. It's going to be choppy. But other people are saying, what's to stop it? If we don't get a hard landing, and if the Fed has shown a willingness to normalize or surgically cut or whatever you want to call it, rates go lower.
Why the fingers? You're not buying it?
The bottom line is this. If the Fed has stopped hiking rates, period, full stop. If the Fed is prepared to cut rates, period, full stop, they can maybe not make the period full stop, but they're, essentially they're preparing to cut rates, then what's to stop this feeling that they're on your side if you're a market participant?
Well, you just keep ignoring them, don't you? Goolsbee is trying to push back. Mester saying it's too early this morning in the Financial Times. We heard from New York Fed President Williams on Friday doing the same thing. What strikes me, Lisa, is the selective hearing of this bond market and financial markets that we've heard now for more than a month. When you get the pushback, brush it to one side. If you see any sign of encouragement, grip it really tightly. Because when we start to think about what's going to happen with inflation, let's go back to Neil Dutz of Renaissance Macro. They are still saying if this continues, we can consider doing this. It's just that for Neil and many other people, they don't think that if is that large. They think the disinflation in the pipeline we're going to see come to the surface over the next several months, and they'll be in a position maybe as early as March to be cutting interest rates.
That's well said. And I will just say this. The thing that changed over those 12 days between Jay Powell's one speech and the other one that sounded very different was disinflation data that came out strongly showing that price pressures were alleviating. To me, one of the biggest reasons why I'm so focused on this Red Sea issue and the shipping containers that are not going through that particular area is that these are the kinds of exogenous risks that might have a bigger impact than some of the other knowns that are baked in. Because right now we do see disinflation. The Fed is responding to it in a way they find appropriate.
Maybe they feel confident enough to come out and just call it transitory. Just say the T word.
Go ahead.
About the shipping canal.
Yeah.
All that stuff. Okay. Here are the scores. They're trying to push back. It's not stopping this rally. Your equity market looks like this on the S&P 500, positive by 0.25%. A yield to doing nothing, 390. 90 on a 10-year. In foreign exchange, the euro just a touch stronger against a weaker dollar. 109.19 on that currency pair, positive by 0.2%. With us around the table is Mira Pandit, the global market strategist at JP Morgan Asset Management. Morning, Mira. A 2024 economy. That's what you're looking for. What is a 2024 economy?
So a 2024 economy in 2024 is 2% growth, 0 recessions, 2% inflation, and 4% unemployment. And the way we get to this relatively benign outlook is from a growth perspective, we've had 5 consecutive quarters of above trend growth. Right now we're tracking for potentially 6 if we look at how some of the numbers are playing out for the fourth quarter. So really getting to a normalization of trend 2%. If you look at inflation, we're seeing that shelter is still the lion's share that's left over. It is starting to decelerate slowly but surely. We're seeing some measures in the real economy that indicate that. You've seen core goods deflation for 6 months in a row. Gas prices are coming down. It's true that the consumer is experiencing headwinds, lending conditions are tight, rates are high. So recession risk is not entirely off the table, but it is not our base case. And those things together we don't necessarily think can push us into recession itself.
Aren't you describing the pre-pandemic economy? Is that what we're going back to?
Exactly. If you look at a lot of dynamics that we're seeing today, it looks a bit like 2019. Look at the unemployment rate. Look at the level of job gains that we've been seeing. Even if you look at job openings kind of heading towards that type of labor market. So what we are definitely seeing is something that looks like post-pandemic normalization still to get back to a regular economy next year.
Stock prices aren't pre-pandemic prices, though. So how much can you say that this hasn't been baked in already and that there's that much more room to run?
I think that's a good point, because while our economic outlook is relatively benign, I think we want to temper expectations a little bit around the equity market, given what we've already seen. I mean, we never want to hate a rally, and I feel like this rally has been causes some reluctance, except for now, because we have finally completed the trifecta of upside surprises. You saw an avoidance of a recession, and in fact, we saw a recent acceleration in growth. We've seen inflation come closer to the Fed's 2% target, and now the Fed has finally acknowledged not only did we pause, but we're also thinking about cuts.
Okay, pause. Does it concern you there are no bears left? You said until now. Suddenly we've got the euphoria. The bears have been, shaken up, put to the side, shamed, rejected. Isn't that concerning, given the fact that you want a certain degree of naysayers, of dissent?
Here's the bear case going into next year. And again, I wouldn't say we're overly bearish given our economic outlook. We still think we could see single-digit returns. But compared to some of the other estimates across the street, I think there's three things that we have to think about for the equity market next year. One, there's not a lot of catalyst for the rest of the year, but when we come back into January and we start to hear from CEOs again, even at 5% growth, CEOs in the third quarter were saying, we're seeing a gloomier outlook, we're going to see some constraints on revenues. So I think you'll continue to hear that in January. That'll throw a little bit of cold water on the rally. Two, we've seen an extraordinary amount of rate volatility this year, but an extraordinary underwhelming amount of equity market volatility. So perhaps those start to meet in the middle a little bit. And then the multiples. Simply, we've had this macro hyped multiple expansion. So we could start to see, as the micro stories bleed in a little bit more, that, okay, we have all the good macro news behind us. How does the micro play out in 2024?
The character of the rally has changed. I think we should be open and clear about that. Tech was ripping, leading for a long time. Starting to see it broaden out. Is that something to hold on to?
In some ways. I mean, I think if we consider the macro environment and what can help next year, if you have inflation that is decelerating and rates that are coming down, that tends to be good for growth. We want to be a little bit cautious around the Magnificent Seven, given the rally there, given the 40% overvaluation there of those stocks relative to history. It's about a third of the index if you look at the top 10 stocks, but only about 20% of the profits. People think all the profits are coming from the Mag 7. There are other sources of profitability. So I do think we think a little bit about the broadening. On the macro side, look, there's still some support for growth in general, because again, falling rates, falling inflation, and you do see with a lot of these growthier companies, ample cash on balance sheets to deploy that's also earning interest. And you also see that there's still growth versus value, more spending on things like R&D and CapEx, so that future growth will hopefully be achieved. But I do think you've seen so many other areas of the market that are beaten down because they're value or they're cyclical and the macro tailwinds are not there for them. But certainly the valuation tailwinds are there. And if you look underneath the surface, there's still a lot of quality in those sectors that I think that there is to be had for investors.
That's sectors. Let's talk about size and geography. Small caps have started to participate in a bigger way, seeing record highs in France, Germany, over in Europe. Talk to us about international just a little bit more. Constructive or not?
Constructive, because you're finally seeing some progress from a dollar perspective. And it does sound like if the Fed pauses and starts to cut before the ECB and the ECB wants to hold on a little bit longer before they do start cutting, that's going to provide additional tailwind for the dollar. So from a U.S. investor standpoint, that is a benefit. What we have to think about a little bit as a countervailing force and as a floor to the dollar is the fact that growth differentials in the U.S. versus outside the U.S. are still likely to favor the U.S. itself. But certainly that remit is broadening out when we think about the attractiveness of international stocks in places like India, continued rally in Japan, perhaps in favor of areas like Europe and China, which could see a sentiment rally, but is still dealing with some deep-seated issues.
Given the underperformance, I was looking at the fact that the Magnificent Seven had a 75% rally so far this year and account for, as you said, about a third of the S&P 500. Do you expect these stocks to actually underperform and for the S&P to underperform next year simply because they don't have that much more room to go?
It's possible, but that prognostication is made many times of what will stop these stocks. And again, the macro environment is relatively supportive if you think about where growth and inflation and rates are heading. So I wouldn't bet against them, but I would diversify around them to a greater extent.
Strip out the Mag 7, S&P 500. Really hasn't done that much compared to when you have it in.
12%, I believe, something like that. We're looking at laggards that have still gained, but just have lagged behind to such a degree. And then you take a look at some of the small caps. And every year, everyone says, those underperformed.
Yeah, this is the moment. This is the moment.
This is the moment.
We've seen a relief rally, I would say. Would you call it that in a financial? Is a relief rally off the back of what's happened in the bond market? What do I need to see for that to continue?
I'd say you'd certainly seen a relief rally in other areas outside the Mag 7, outside growth. You bring up small cap. I do want to highlight that we're a little bit cautious on small cap.
Why is that?
A bit more of a relief. One, if you do have an economy that is slowing, even if it's positive, but we're coming down from above trend growth, that's not necessarily great for a lot of these very domestically levered companies. And also, if you think about some of the debt dynamics, it's great to see cuts, but we're still going to be at policy rates above 4%. And in that environment, you want to think about the nature of how these companies have taken on debt. In the Russell 2000, about 38% of the index is floating rate. In the S&P 500, that's about 7%. In the S&P 500, about 49% of debt is termed out beyond 2030. That's about 14% in the Russell. So this higher for longer, even if it's not as high for as long as we thought, it's still at the baseline that we're going to be operating in next year. Could be a little bit troubling for debt service.
This goes back to the conversation of this morning, the difference between cutting rates and easing policy. Mira, love it. Great to catch up. Mira Pandit there of JP Morgan Asset Management. Here's the market for you. The scores, if you are just joining us, positive on the S&P by 0.2%. Yields just about unchanged on a 10-year, 391.27. The conversation, without a doubt, is on rate cuts next year. And the difference, Lisa, this morning between cutting interest rates and easing policy. We heard from Priya Misra of JP Morgan Asset Management this morning saying that this was about normalizing. That's the word you should be thinking about right now.
Which is actually the best case scenario for risk assets, because it means that they're cutting rates simply in response to inflation coming down, not in response to actual economic pain. That's really the question. If they're cutting to stimulate, that creates something else. I do want to bring this to you. Dick Beauvais of Odeon Capital writing in, explaining why banks benefit from rate declines, talking about how there is an increase in real equity, increase in leveraging capacity, and an increase in secular earnings growth. So basically why rate cuts can be good, lower rates.
For banks.
For banks.
New regime.
Yeah, exactly.
New regime.
Until it's not
Smart
anymore.
take, yeah, precisely.
There's, you know, a like glide path.
Yeah. Coming up very shortly, Bill Dudley of Bloomberg Opinion, former New York Fed president, on his latest column. The headline, Jerome Powell's pivot is a pretty big gamble. We'll talk about that pretty big gamble in just a moment. From New York City this morning, stocks are higher. They always are these days, aren't they? Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
Welcome.